Yeah, no, yesterday I had right in front of my car and I just like stopped like right in front.
How far are you away from here?
35 minutes. So
Would
it's
you like
like
a cookie?
no.
Cookie?
No, thank you.
Cookie? Water?
How do you know that? Are you ready for the chocolate?
I got water. Actually, I want to see if
Conventional thinking doesn't disrupt the status quo, which is why T-Mobile for Business uses unconventional thinking to help your business realize new possibilities. All in one private network offers unmatched network support and routing without any trade-offs.
Hello. How are you?
This is
Oh, good.
my kitchen table, and it's also my filing system. Over much of the past 3 decades, I've been an investor.
Yes.
The highest
Yeah.
if it's easier on you.
Mm-hmm.
I just don't know because I need to get some computer. But I don't want it to be in front of the camera.
Yes.
What's it? That's good. No, I just need to.
It's fine. We can manage like this. It's fine. Okay, it's okay. It's chair here.
Well, let's give him a call tomorrow morning. Yeah, I'll call him at. Mm-hmm. Yeah, sure. Right. Yeah, we'll call him in the morning. I mean, we'll get up early and call them. It's 6. It's 9 o'clock his time, and you know, and I'll let you know, or I'll put you on the call too. Okay. 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 Yeah, I'll make those calls in the morning. Okay, you're welcome. Take care. All right, you guys ready to get started? You know anybody else that's coming?
No. We came yesterday.
Is it?
so-
Okay. How many people are in the class? I was trying to pull it up, but my Gale Express
I
wasn't
think
working.
14.
I think there's like 15, but
15?
physically there's like 6.
Okay, so physically 6, 14. I think there's some others on the call. Let's see. Oh yes, we have Neha. Hello, can you see me?
Hi. Yes,
Okay, can you see me?
I can hear.
Okay, can you hear me or can you see me?
Both, I can hear you and see.
Okay, okay, good. Joseph, how are you?
I'm good, thank you, Professor. How are you?
Good. How you doing, Brandon?
What's up, Dr. Souza? How are you? Nice to have you again.
Yeah, well, yeah, you look familiar. You look older. I think that's the mustache.
Maybe, I don't know.
Good to see you. How's everything?
It's good. Happy to finally kind of be out of the pandemic. Hopefully I can join your class after this week. So.
Okay, awesome. Look forward to it. Kamalia,
Hi,
how are you?
I'm good. How are you?
Good, thank you. Jada, did I say hello to you?
Hi.
How are you, Francisco?
Yeah, hi, Professor.
how are you? Danielle,
Hi, Professor. How are you doing?
how are you guys?
Good.
Good. Are you guys coming in, or is this, are you gonna be on Zoom the whole time?
I'll hopefully be coming in next week as well.
Okay, cool. Well, you guys can still be in teams and work together on the PowerPoints and, you know, do your presentations and stuff next week. Does that sound okay? Yep, okay. So Joseph, Brandon, and Danielle, you guys will be a group.
Good.
France, how did I say your name again?
Francois.
Francois? Okay. Let's see, who else do we have on here? Francois, Neha, Angelo. So that's another, let's see. So, let's see, so I'm gonna have to write these down, because I don't have my list in front of me. I'll do these guys first. Okay, so Brandon. And then Kimaya, is that how I say that?
Maya.
Maya?
Kimaya.
Kimaya. Okay. Got it. And then Joseph. You guys are going to be team 1. And you're going to do chapter 1 and 2. Okay? Jada, Neha, and is it Kimaya? Oh, I know, I already have it. Sorry, these things just keep moving on me. Francois. Jada, Neha, and Francois, team 2. And you're going to do chapter 3 and 4. Okay. Danielle. Angelo. Okay, so I got everybody. Brandon. Brandon. Brandon.
Yeah.
Okay. So team 1, chapter 1 and 2. Okay. Again, I'm learning your name, so I apologize if I'm having a hard time. I have a hard time. Kimya? Kimaya? I'll get it. Kimaya and Joseph?
Yep.
Okay. You guys are team 1, chapter 1 and 2. Okay. Jada, Neha, and Francois. Okay. You guys are team 2, chapter 3 and 4. Okay? And then I have Danielle and Angela. Is there anybody else I'm missing on Zoom? No? Okay. You guys got to help me out. Okay. All right.
Missing anyone. That's good.
And then, I'm sorry, what was your name again?
Nadine.
Nadine? Okay, Nadine, you're going to be in team 3.
Okay.
Chapter 5 and 6 with Angelo and Danielle. And then do you guys have the Zoom up on your computers? You should have.
Download it?
You should be able to go into, well, you should have the course.
Yeah.
The course website has the Zoom link.
Do you
No,
want us
yeah,
to log in
we-
while we're in class?
Huh?
Do you want us to log in while we're in class?
You should, because some people are going to be, you might have to put in the chat, or they may put stuff in the chat.
Oh.
I've never done a high flex, never done a hybrid class like this. They're either usually all online or they're all in the class. Okay. So I think you should just have it up, so if you want to communicate, post your contact information to share with everybody. I highly recommend that you guys all, work together on stuff as opposed to trying to do everything by yourself. Okay. So Nadine, Angelo, and Danielle, team 3, chapter 5 and 6. And then you should all put your contact do you guys have each other's contact information?
Not yet.
Okay, then you guys probably should put your contact information into the chat so that everybody has it. Okay? And then, I'm sorry, I forgot your name.
My name is Gabriela.
Woo! What's your name again? I'm sorry.
Mute it. Gabriela.
Okay. And then,
Kron, K-A-R-A-N.
how do you say that?
Kron,
K-A-R?
A-N, yes.
Okay, excellent. And then, I'm sorry,
Say Donna.
say Donna. Okay, and then you guys will be team 4. Chapter 7 and 8. Okay, and you guys can be team 5.
Wait, who?
I'm sorry, what's your name?
Nerali.
Nerali and your name?
Jackson.
Jackson.
Yeah.
So Nerali and Jackson. And then you guys are going to be team 5. And you're going to do 9 and 10. Okay, for the chapters. And we'll start with that. Okay? All right, and then I'll go through the website. The PowerPoint presentations are already there for you with the notes and everything. You can just, read them, present them to us. It doesn't take too long. And then if you get stuck or confused, you can just read the captions at the bottom and just walk us through. Okay? So it's pretty straightforward. The philosophy for the class will be, we'll probably spend about 40 minutes every class at the beginning of the class. Okay? You want to come prepared, or when you come to class, get on your computer and start doing research on the markets. Okay? And I think I mentioned that in the email that I sent you, where you want to start tracking the stock market. Okay? I track the Dow Jones Industrial Average, which is a fairly small sample of stocks that make up the stock market index that tracks the performance of the stock market. The stock market is a leading economic indicator. Okay, you're all, if you haven't already, and you people online, if you haven't already, you're going to own stock in some way or another. Either if you're lucky and you have rich grandparents and parents, they're probably within their wills and their estates, or probably if they don't, spend through all of their money in retirement because they lived too long or didn't save enough, you're probably going to inherit some equities. Okay, and if you go work for a company, most companies will provide you with a 401k, which is a retirement account, which is basically tax deferred, and you'll probably be invested in exchange traded funds or ETFs or individual stocks. or mutual funds, and that's will be a major component of your wealth that you will accumulate. Okay, so you're exposed to stocks. The stock market is a leading indicator. Everybody watches it. The New York Stock Exchange opens at 6 o'clock in the morning, our time. 9 o'clock their time, closes at 1. Our time closes at 3 East Coast time. The New York Stock Exchange is the biggest stock exchange in the world. It's called the Big Board. There's stock exchanges all over the world in major metropolitan areas, or what are called money center banks. And those stock markets and those stock exchanges basically represent some of the biggest companies within those countries. Okay, and you can buy stock, what are called ADR, or American Drawing Rights. So you could invest in SAP or some Sony on the New York Stock Exchange, because those foreign stocks are listed and traded on the American Stock Exchange along with the Tokyo Exchange. So you could invest in global equities, you could invest in global stock mutual funds or exchange traded funds. You are going to own equities. You're going to be exposed to equities, so you have to start learning about them. Okay, and the Dow Jones is one index. The other is the Standard & Poor's, or the S&P 500, which is the top 500 companies listed on the New York Stock Exchange. So they have to meet a certain requirement of assets, growth, and earnings, and size, and quality. They are the top 500 highest quality companies on the New York Stock Exchange, and that's also created the S&P 500 index. The Dow Jones and the S&P 500 index have been around about 147 years. Okay, most mutual fund managers or equity portfolio managers will benchmark their performance of the management of those stocks based on the S&P 500. And if they can beat the index consecutively over time, then people will invest in their funds, and those funds will get really huge. They'll charge a fee and make a lot of money. Okay. The other index that you want to be watching too is the NASDAQ index, the National Association of Security Dealer Quotes. The NASDAQ exchange, the NASDAQ is an exchange where actually broker-dealers trade stock on the exchange. It's all online, and the majority of the stocks that are listed on the NASDAQ exchange are tech companies. Okay? So when tech companies go initial public offering, and they usually get listed on an exchange with the ticker symbol, ticker, they usually go to the NASDAQ exchange. Okay? And then at some point in time, depending on if they want to, they can then migrate to the New York Stock Exchange because of the liquidity and the prestige of being listed on the New York Stock Exchange. Okay? So that's basically the equity market. And you can go up to Yahoo, go up to Yahoo Finance, you can go to Y Charts, you can go to Big Charts, you can go to stockcharts.com, you can go to a lot of different sources to be able to find the stock market indexes, and I'll show you, what it looks like in a minute after I go through kind of the orientation. And every day, if you go up to Yahoo Finance, or you go to the Financial Times, or the New York, the New York Times, or the Wall Street Journal, these are all financial newspapers. They all have web presence now. They all post basically what the markets are doing, what they opened at, what they closed at, what was moving the markets during the day, what announcements, either political announcements, economic announcements, earnings announcements from major companies that are listed on those exchanges, like Apple is a good example. That'll move the market, okay? And people bet on the direction of a market. You can trade. If you think the market's going to go up, you buy. If you think it's going to go down, you sell. There are also derivative contracts that you can use, option contracts that you can use to trade not only the indexes but individual stocks. And people use option contracts because I could take $100,000 and create $10 million in leverage trades from my money. And if I'm right, I make more money. If I'm wrong, I lose money. The stock market is a reflection of capitalism in the United States and all over the world. It's the way that most companies, when they need money to invest and expand, will issue stock to raise the money to invest in plant and equipment and expansion. If companies like Apple, Intel, Amazon, those companies, you had invested in them 20 years ago, little money like, I don't know, $5,000, 10, 20 years ago, it'd be worth $500,000 at $5,000 today. So with little money, if you would have invested in those companies, you'd be a multimillionaire by now. Okay. So the stock market is a major source of wealth accumulation and the way a lot of people accumulate wealth and save for the future. Okay. And I'll go through, every class. We'll spend some time. I'll be asking you, where did the Dow Jones Industrial Average close today? Is it up or down? By how much? And can you give me 3 factors that drove the stock market up or down? Okay. The stock exchanges, particularly the Dow Jones Industrial Average, if it moves about 100 points within one day, that's just noise. Okay. And you guys need to be writing notes, because what happens is, I go through these lectures over and over again, and students don't take the notes, and I ask you to refer back to your notes, so I don't have to explain everything, the whole time. So taking really good notes, you're going to get graded on your notes. It's part of the deliverable, okay? And I'm going to be going over exams, and you're going to be taking notes, and that's how I'm going to grade you from your notes, okay? I can give you an exam, you could take it, you could fail it, you could cry, and I'd have to give you, a grade, right? But that's not the way I'm going to do it. It's going to be based on your work, your participation, your interaction, your ability to actually apply the economic theory. And the first part of the class will do that. For about 40 to almost 60 minutes, we'll go through the markets, and I'll train you on how to think, not only like an economist, but think like a financial economist, or a CFO, or CTO, or CIO, or COO. These individuals are all experts, okay? Most major CEOs of major corporations went to Ivy League schools, okay? They went to really good schools. They were maybe good at math, but maybe they weren't good at, social skills and communication, but they became good at it. Or some CEOs came in with impeccable sales and management and personal communication skills, but were weak in the technical aspects associated with the business. But they became experts at the technical aspects. So they understood where their weaknesses were, they attacked those weaknesses, became good at both. Okay? So a lot of the top executives within these companies understand the marketing, understand the operations, understand the technology, understand the finance, understand the accounting, understand economics, so that when they're talking to people in a room, depending on what the goals and objective is for that meeting, they can talk at that level to that individual in the language in which that person is an expert. Therefore creating extreme precision in the communications, because you're not translating. So I'm talking marketing to the marketing people, finance and accounting to the finance and accounting people. I'm talking technology to the technology people. Okay, and that ability to be multilinguistic, to be able to know who you're talking to, and to be able to talk at their level. I can basically take an hour conversation and boil it down into maybe 10, 15 minutes, because I'm not translating. I'm speaking to them at their language, okay? And when you sit in on more of these senior level executive meetings, particularly the strategic planning meetings or the tactical meetings as opposed to the operational meetings, they're talking about the economy, they're talking about economic cycles, they're talking about interest rates, they're talking about what the Federal Reserve is doing, they're talking about tax policy, they're talking about what Biden's doing and what policies he's pushing through. And the debate between the two parties, and the composition of Congress, and the probability that those policies are going to be enacted. And if they're enacted, what are the policy outcomes? And what are the intended and potential unintended outcomes associated with those policies? And what's the impact going to be on our industry, and our clients, and our customers, and our company? That's what they're constantly thinking about and talking about in these meetings. And I want you to be able to, at the end of the class, be able to sit in these meetings and participate in those meetings, and not only give your own interpretation and your own analysis, but also to be able to listen. And if they do ask you questions, to be able to respond correctly with your interpretation and your analysis with a recommendation. Okay? So the first is the stock market. And I'm kind of blending everything so you can kind of hear where I'm going here. I'm kind of giving you my best practices and my own personal business experiences, but also my academic background. And then I'll get into a little bit about that after we do some introductions too, but I'm just going right to the business. The next is the oil markets, okay? There's two markets. There's Brent crude that's priced out of the Middle East, okay? Mostly dominated by Saudi Arabia and OPEC. And actually they just had a meeting the other day, and the meeting actually failed, which means that OPEC did not come to a consensus on basically how much they were going to produce into the global oil markets. So that meeting failed, and the price of a barrel of oil spiked about $3 to about 77 bucks a barrel. Okay? As the price of barrel goes up, your cost of living goes up because your gas goes up. And the materials within these shirts and our computers and everything around you is basically made out of plastic, which is petroleum products. So oil is not only a consumer consumption good, but it's also the major input into industrial production for most companies, particularly in transportation. Okay? So oil is major. And oil is a geopolitical commodity also, because it's produced in the Middle East, which is one of the most volatile geographies in the world. You have Sunnis and you have Shiites battling it out. You've got Israel, against Hezbollah and Hamas. These are all impacts and effects on the oil markets, particularly when you have Hamas or Hezbollah basically, attacking a Saudi Arabian oil tanker in the Straits of Hormuz. If a war broke out and the Straits of Hormuz was basically blockaded, the supply chain of oil coming out of the Middle East would be blocked and oil prices would spike. Okay? So people are looking at oil on not only from an economic input and an economic standpoint, but also geopolitical, and the geopolitical impacts and effects on the marketplace. Okay? And again, I'll go through all of the economics. I'm just kind of giving it to you now so we can get started. The other major commodity is gold. Okay? Gold prices per ounce. Now, gold is interesting too. It's got a geopolitical aspect associated with it too. It's not only economically driven due to supply and demand, but it's also geopolitical. One of the major purchasers and holders of gold are foreign treasuries and central banks. Okay? And the one key component about gold, which is extremely important to understand, is it is highly correlated. Okay? It's highly related to inflation. Because individuals and investors will buy gold when they're scared. Okay? They think that geopolitical unrest or a COVID outbreak is going to significantly hurt the economy, and people are uncertain about the future and inflation and just their livelihood, their store of wealth. They're going to go into gold as a store of wealth, as protection, okay? Which they did last year, okay? People are buying gold now because they're scared of inflation, okay? And inflation is bad, okay? Because if your wages are not rising as fast as inflation, the commodities that you buy are costing you more and more and eating up your disposable income, which basically means that you have less disposable income for savings, consumption, and investment, which means your standards of living are falling. That's one of the biggest fears. And you could look at Panama, that's a perfect example of Germany in the 30s and other countries going back in time, and hyperinflation, inflation destroyed the countries, destroyed people's lives, okay? So gold is a store of wealth. It is a hedge against inflation and to protect your purchasing power. And usually in countries that see high inflation rates or hyperinflation causes their currency to depreciate, okay? Causes their currency to depreciate, which means the value of your money is falling, okay? And when they see that the value of the money that they worked all of their life to save starting to get wiped out by inflation, they will start to invest in gold as a way to hedge the devaluation, depreciation of the currency. Okay, yes, sir.
Is there a way to purchase gold without actually purchasing like the gold bars, like investing?
Yeah, you can buy gold certificates. You could buy gold company exchange traded funds. Okay, so there are products, financial products out there. And I'll talk a little bit later in the class about financial product innovation, because I'm basically a financial engineer. Okay, when I first started in my academics, I saw no difference between being an engineering student and a financial engineer. The mathematics are all the same, except that the mechanical engineer is creating mechanical components, right, the machinery, to do whatever it's supposed to do. The financial engineer takes the same mathematics and basically designs financial products as tools to be able to solve problems for the marketplace. Okay, and I'll talk a little bit about derivative contracts, option contracts, futures contracts, forward contracts, which are basically financial innovations created by financial engineers in Wall Street banks decades ago to basically provide these products to allow for institutional investors and other investors to be able to hedge, okay, and do things because they were scared of inflation or rising interest rates. So they were tasked by the marketplace. Wall Street had the financial engineers. They engineered the financial products to basically solve the problem. Okay? No difference between the two. One's tangible, the other's intangible. Okay? But the mathematics are the same. And you all are IT? Technology background? No? No?
Business administration, concentration in marketing.
Okay.
Yeah, that's what I am as well.
Okay, awesome. Okay. Same thing. Financial products use the same marketing techniques. You know, it's all product attributes. It's basically selling into the marketplace using all the social media and marketing campaigns and techniques that you would use for tangible products. You're just selling financial products as opposed to tangible products. Same thing, just a different market, different product. Okay? So gold, you want to start tracking gold, okay, per ounce. Is it up? Is it down? By how much and why? Okay? And when you start reading the articles on the external research, when you go out and do the research and start looking up, you know, what happened in the gold market today, or over the last week, or the last 2 weeks, or the last month, or 2 months, or 2 years, because we're always looking at trends and patterns in the data, you start asking the questions why. Okay? What are the economic theories that are driving these prices up or down? And you know, what's the explanation? Once you can understand the economic factors that are driving the price movements within these markets over time, or within the immediate time period, then you start to become a trader. Okay? And you start to use the information and the economic theory along with the statistics to be able to place trades. Okay? And just to give you an idea, there are trillions and trillions and trillions and trillions and trillions of dollars invested in the 5 asset classes I'm going over. There are trillions and trillions and trillions of dollars traded 24 hours a day, 7 days a week, 365 days a year on a global basis. Trillions of dollars being traded and invested every single day. Okay, just to give you an idea of the magnitude. All right. The next market is the bond market. Okay, there's corporate bonds and there's U.S. government bonds. There's sovereign bonds, which are bonds that are issued by countries. Those are sovereign bonds. There are corporate bonds that are issued by corporations. The U.S. in the United States, the U.S. Treasury issues the bonds when the government runs budget deficits. Okay? So we ran a $3 trillion deficit over the last year, the most in history. Okay? And I'll talk about unorthodox monetary policy and fiscal policies because the economic books are great, but they're theoretical and they're out of date. Okay? Where I'm applying the economic theory in an applied context every second of the day. Okay? Trying to find new patterns, new influences, new explanations to be able to communicate with people on what's going on and what's going to happen and what are the opportunities and risks. And that's why I sent you that presentation for tomorrow, so that if you want to see how I communicate in the presentation that I make, and I'll make that presentation for you guys here in this class too, but you can, if you want, I sent you the invite to be able to see how I communicate with my clients, okay? And what I go over and what I talk about. And there's no difference between that presentation and the ones that I'm doing here in the class, okay? It's basically the same. So the bond market is huge. The fixed income bond market is called the fixed income market. The stock market is called the equity market. The bond market is called fixed income. There are sovereign bonds and there are corporate bonds. Okay. Now, the bond market is the biggest financial market in the world. Bond prices and interest rates. So the bonds, when I buy a bond, I basically give the government $1,000. Every 6 months, the federal government will give me a little interest check. And at the end of the maturity, which could be a year or 3 years or 5 years or 7 years or 10 years or 20 or 30 years, whatever, the maturity of the bond, they're going to give me my $1,000 back. Okay, and that's the principal. So I'm going to get interest in principal. Okay, but the problem is that the interest rate in which the government issued the bond, okay, the coupon interest is fixed. Okay, but the market interest rate fluctuates. Okay, so the bond price fluctuates.
What's the benefit of the bond market versus the stock market?
People invest, let's say, in high-grade corporate bonds, or will invest in a good sovereign government bond, because you're guaranteed the interest payments and the principal at the end. So if I buy the bond and the yield to maturity on the bond is 5%, I'm going to get 5%. And my yield to maturity at the end is going to be 5% per year over the maturity of the bond. The problem with bonds is the coupon interest is fixed and the principal amount is fixed. It doesn't move with inflation or growth of a company. You are given a stated fixed interest payment that doesn't change. And the principal at the end, the $1,000, will be $1,000 at the end.
So does that mean it's sort of a guaranteed equivalent?
It's guaranteed.
Put in your mattress, your money under your mattress?
It's this U.S. government treasury securities theoretically are the safest and the most liquid of any bond in the world. Germany is pretty close, Japan's pretty close too. Some of the best countries have the best bonds, but Venezuela does not have a good bond. Panama does not have a good bond. Neither does Brazil or Argentina or Turkey. So for them to raise money in the bond market, they have to provide really high interest rates for investors to take on that sovereign risk. And the biggest sovereign risk for investors investing in foreign bonds is inflation. Okay? Because my interest rate is fixed. My principal amount is fixed. If inflation goes up, it deteriorates the purchasing power of my coupon interest rates and the principal that I get at the end. So the bond market is huge. The bond investors are a huge constituency that will hold central banks to lower moderate inflation rates, because if they don't regulate the inflation rate, the purchasing power for those bonds evaporate and investors are worse off. So the bond market, remember, you need to write this down, that bond prices and interest rates move in opposite direction. So if interest rates go up, bond prices go down. If interest rates go down, bond prices go up. You need to memorize that. And I'll be asking you questions in class and over the duration of the class. When we do this orientation, I'm going to ask you, what did the 10-year Treasury yield do today? Is the 10-year Treasury yield up or down? Well, if it's up, then bond prices went down. Okay? Now, where did the 10-year Treasury yield do today? Interest rates went down. The 10-year Treasury went to 1.43. That means that bond prices went, got it. Okay? So I'm going to test you on this. And at some point, I'm going to stop lecturing and you're going to start discussing what's happening in these markets. Did they go up and down? And start giving me the economic theories of why you think they went up or down. And in the articles, they're going to tell you what the factors were that are driving the prices of these major asset classes up and down. Okay? And I'm going to train you on that too. So the 10-year Treasury is extremely important because it's a benchmark interest rate. Okay? Your student loans, your car loans, your personal loans, your mortgage interest rates for, to be able to buy a home is tied to the 10-year Treasury. That is the base rate. That is the risk-free rate. Then the bank basically starts tacking on risk premiums, credit score, collateral, quality of the house, location, schools, and starts adding on risk premiums to get to a final mortgage interest rate, or personal loan, or business loan, or student loan. So the 10-year Treasury, okay? And I'll go through with you how you calculate the nominal interest rate for bonds. Okay, so you have the theory behind it. So the bond market is huge. The next is the currency markets. Foreign currency and the US dollar. The US dollar is also called the USD. Okay? Foreign currency is called FX. Okay, in capitalizations. So we talk about the US dollar and we talk about foreign currency. Theoretically speaking, the value of the US dollar in foreign currencies move in opposite directions. So if the dollar appreciates in value, foreign currency depreciates. If foreign currency appreciates, then the US dollar depreciates. And the currency markets are just as big and probably bigger than the bond market because of international transactions. Over the last 30 years, particularly with NAFTA and the World Trade Organization and other, global trade agreements, multilateral trade agreements, has basically increased the overall volume of international trade. Because the economic theory basically states that certain countries can do things better than other countries. And if they're good at one thing, they could basically trade with other countries, and they're better off. So instead of one country, you know, farming bananas, you know, and building semiconductor chips, if you're good at, you know, producing bananas and you need semiconductor chips, you know, for your computers or other types of inputs into your manufacturing, you're better off trading because of the productivity gains and the specialization between the two countries. So instead of bartering, you're exchanging. And you allow countries to do what they do well and exchange in the marketplace. Now you can exchange between euros and dollars and euros and yen and dollars and yen and dollars and pesos, pesos and rubles. Certain countries have their own currencies. Okay? And currencies will appreciate and depreciate, not only based on geoeconomic and geopolitical factors, but also economic factors. So you'll see currencies appreciate when economic outcome or economic forecasts for economic activity are revised up. If the investors think that the stock market is going to outperform in the near future, they will dump their domestic currency and invest in the foreign currency to invest in the foreign stock market. Same thing with the real estate market. So if they can get better returns or inflation-adjusted returns or real returns someplace else, they're going to dump their domestic currency and go someplace else. Because international investors can go anywhere they want. It's basically a free capital market. There are not a lot of currency controls for a lot of the developed countries. So basically investors can move their money in and out of countries with relative freedom. Other factors that would affect currencies, high inflation will cause currencies to depreciate quickly. Yes?
Which currency would that depreciate, the US dollar or the foreign?
If the United States inflation rate is significantly higher than other country inflation rates, you know, on a comparative basis, the US dollar will depreciate against foreign currency because the inflation rate is higher. Okay? If it's lower, then the dollar will appreciate compared to other foreign currencies because the inflation rate is higher in foreign countries than it is in the United States. If the rates of return on the stock market and the real estate market is higher here than in other parts of the world, people are going to dump their currencies and buy the US dollar. That'll cause the foreign currency to devalue and depreciate and the US dollar to appreciate.
Who's investing in currency?
Everybody.
Like individuals?
Governments, corporations, individuals. If I'm Apple Computer and I have a transaction where I'm basically producing most of my semiconductor chips out of Guangdong or Guangdong, you know, out of China, I'm going to exchange my dollars for the yuan or the renminbi to invest in plant equipment and to purchase those chips to source to then be used in the iPhones and the iPads.
So you'll basically buy the money that gives you better return for what you're purchasing.
Well, what they did is they're exchanging US dollars for Chinese currency to buy production capabilities. But if I think that right now, people are looking to Europe. The United States is coming out of a very strong bounce out of the pandemic. They were forecasting 10% in economic growth, measured by gross domestic product. You want to write that down, GDP. They were forecasting 10%. They revised it down to between 7 and 8%, which is still historically high. So the US stock market will probably continue to do well. But Europe seems to be coming out of its economic recession. If it can just quell the outbreaks of the pandemic, which seems to be occurring, which has a major economic impact on countries when they have to lock down their workforce and their production. The view is that Europe could actually see faster growth in the next year or two compared to the United States. So some investors are actually considering now taking some of their profits out of the US stock market and moving into European equities, European stocks. So everything is always forward-looking, okay? And I'm going to be talking about factors, and we're going to be talking about forecasts. Where do you think economic activity is going to go? Where do you think the stock market's going to go? Where do you think oil prices are going to go? Where do you think gold prices are going to go? Where do you think bond prices are going to go? Where do you think currencies are going to go? And they hire people basically to make those forecasts and then make those trades either for their companies or on behalf of their clients. Okay? And we have a fiduciary responsibility to learn this stuff, to be able to provide expert advice to our clients in our companies. If you can do that, you'll be extremely successful, okay? Because you'll have the credibility. And if you're right most of the time or almost all the time, then you're going to be extremely valuable, right? If you can advise your company or your clients and you're right the majority of the time because you can apply the economics, you can apply the management theory, the marketing theory, you're applying all of the stuff that you're learning and your recommendations are correct, you're going to be rewarded for that. Okay? And that's why you're here. Also productivity, labor productivity. If there's high labor productivity in one country over another, that'll cause the currency to appreciate because companies are more profitable. And if the profit margins are widening because of the labor force is more productive because they're able to apply more capital to create more efficiency and make their workers more productive, then those profit margins are going to spill over into earnings growth, and stock price appreciation. So there's some of these factors are correlated with each other, some are causation. Things happen within a certain sequence. You can't go from just, I think the stock market prices are going to go up with no explanation. Usually what's going to happen is the Federal Reserve lowered interest rates. That's going to make borrowing cheaper, which is going to allow businesses to be able to borrow and invest to expand their business. That's going to create economic activity as those companies start to buy labor, capital, land. That's going to spill over into the economy, cause the economy to grow, and cause employment to go up and wages to go up. So there's a sequence to a lot of this stuff. And I'll go through a lot of that stuff for you. So that's basically the first of the orientation. What you want to do is you want to start tracking the markets. Okay? Or when you come into class, jump on your computer and start writing some notes. You know, where did the Dow Jones Industrial Average settle today? Is it up or down? By how much? And what? Same thing with oil, same thing with gold, same thing with interest rates and bond prices, and the same with the US dollar in foreign currency. Okay. Any questions on that? No? Yes? Anybody ever take any economics or finance, or is anybody actually in the market right now? Is anybody trading in the marketplace?
I mess around a little bit.
Okay. Do you guys have 401ks, self-directed IRAs? Do you have any investment in real estate? Do your grandparents have any money? Do your parents have any money? Have they accumulated any wealth in the stock market or the real estate market? Do they have 401ks? Do they have retirement accounts? They're all subjected to basically the cyclicality and the volatility, okay, in those markets. Okay, so you have to take responsibility for your own wealth accumulation. Okay, you have to make really good decisions because you can't afford to lose money. Okay, most places that most people lose their money is it's stolen from them by either their siblings or their parents or their business partners or individuals around them. I've seen it. It's happened to me before. It's awful. I don't recommend it, but that's why you're here, right? To create some intellectual defense so that you can defend yourself, and to be able to make your own decisions and know that the decisions that you're making are correct. Okay? If you can't, then find somebody who can help you, but be careful. All right. So let's. Anybody have any questions or anything while we move on? This is Bloomberg.
Yes, sir. Can I ask a question, please?
Yeah, go for it.
Just go back over that sequence. I got a little bit lost in there.
Okay, so let's do monetary policy, okay, as an example. The Federal Reserve thinks that the economy is going to fall into a recession, okay, and they want to prevent the severity of the recession. So the Federal Reserve will start to print money. The Federal Reserve will print money and will start to buy U.S. government treasury securities in the open market, which is called open market operations, which is a monetary policy tool. Okay? As the Federal Reserve starts to buy bonds, it drives up bond prices and drives down interest rates. Okay? Interest rates of U.S. government treasury securities are the benchmark interest rates. So the interest rates on everything are benchmarked off the U.S. treasury securities. So if the Federal Reserve is printing money, buying these bonds, driving up bond prices, and driving down interest rates, then the cost of borrowing becomes cheaper for individuals and consumers, cars, personal loans, credit cards, and companies who are looking to borrow from banks or borrow in the stock market or borrow in the bond market. Okay? That will drive the cost of capital down, which makes the cost of capital cheaper. Okay? Which means that they'll borrow more money. They'll borrow the money and they'll start to consume and they'll start to invest. Businesses will invest in plant and equipment, which means that every time a plant and equipment is being constructed, you have to hire construction workers, buy materials, and it flows through the economy in what is called a multiplier effect, okay? Because people keep buying from other people, which creates what is called a multiplier effect. So that happens on the business side, through business investment, okay? It also happens on the consumer side, because if it's cheaper for me now, where I can afford to buy a house and furniture for my house and afford to buy a car and to be able to use credit to be able to buy stuff, then by buying stuff, it basically causes manufacturing facilities to have to produce and consume more to be able to produce the goods to be able to supply the marketplace. So that creates economic activity too. So, and then the economic activity and the demand for goods and services increases the demand for labor because you have to hire more people to be able to meet the production requirements. So as labor demand goes up, the unemployment rate goes down. And currently, this is an interesting example right now, currently the unemployment rate has dropped significantly over the last year to the point where you're now actually seeing labor shortages in some industries and some sectors, and some individuals with certain skill sets. And wages have started to go up because of labor shortages. And when wages go up, people have more income and more household income. And they end up investing more and saving more and consuming more, and it becomes a self-reinforcing cycle that moves through the economy. Joseph, did that answer your question?
Yeah, that's great. Thank you very much.
That's how I did it in my econ class. As I was kind of going through the book and reading the chapters and stuff, I was creating like little sequences. You know, like interest rates go down, borrowing goes up, consumption goes up, production goes up, you know, employment goes down, income goes up. Consumption goes up, so you're kind of like, creating some symbols to be able to allow you to be able to memorize the causation, right, in the sequence in which the economic logic flows.
Can you say that one more time real quick?
Yeah, which one?
What you just said? Interest rate goes up, spending goes down.
Okay, so if interest rates go down, the cost of capital becomes cheaper, businesses borrow and invest, and consumers borrow and consume more. That creates increased economic activity. Increased economic activity increases demand for labor. As demand for labor goes up, so do wages and household income, which also flows through into the economy through increased demand for goods and services. So that's monetary policy. Okay. The federal government, fiscal policy, the federal government could actually give direct grants, right? Like they did during the pandemic. They were giving relief funds to individuals to be able to support and allow them to be able to pay their rent and to consume and to be able to buy food and clothing. So that was like a fiscal support. The economy would have contracted even more if the federal government wasn't there basically providing those grants and those supports. The fiscal side, they can also lower your taxes. So if you have less taxes, they lower your taxes, then you have more disposable income. If you have more disposable income, you're going to save, invest, and consume more. That's good for economic activity.
What about the instances where the companies don't invest in that process that you're saying?
Then the effect on overall economic activity will be muted. Okay, and that's what's happened. There were some tax breaks that were given to corporations, particularly multinational corporations. Multinational corporations with the corporate tax breaks, instead of expanding the plant and equipment that they said that they would do, what they ended up doing was basically buying back their stocks, which inflated their stock prices, which made them better off, both the shareholders and the senior executives and the people within the companies that actually had stock options, stock grants, or actually owned the shares. So it was an accounting gimmick. So they took the money that they got, they bought back their shares, driving up their stock prices, making the number of shares outstanding shrink, increasing their earnings per share, and increasing their stock price in the process. So it's financial engineering is what they did. It was an accounting gimmick. Okay. Any other questions? Any questions from the people online? No? Okay. And as you read through the book, and everybody has the book, this is the book. It's a pretty good book. There's a lot in there. I even threw in another book. It's not required, but these were two pretty good books. It's not overly technical, the book. You can move through the materials, and if you don't have time, just read the PowerPoint presentations. You'll get enough content that way, plus our discussions in class. Okay? All right.
I will not, my book arrives tomorrow, right? I haven't done it yet. My book arrives tomorrow.
Okay, that's great. Thank you. All right, so let's go up onto the course website so I can show you. And again, here's Bloomberg. In the syllabus, I gave you my username and password. So if you want to log in and watch and listen, I mean, they have major technical experts, senior level executives, global basis, 24 hours a day, 7 days a week. Bloomberg is huge. Anybody who's anybody watches Bloomberg, okay? Because they track the markets. They're constantly on, okay? And early in the morning, UK and Europe are shutting down. The United States opens. When the United States closes, Asia opens. So you can trade basically 24 hours a day, contiguously across markets, across regions, across the United States. Okay? So there's always information coming out from all over the world. All right? And when you look at economics and the financial markets in a global context, it even becomes more interesting, because different societies are different. Europe's different than Latin America, which is different than Africa, which is different than the Middle East, which is different than Asia, which is different than Middle Asia. So you start adding in the politics with the economics, with the financial markets to come up with investment strategies, okay? Or global management strategies. Okay, so Bloomberg is really good. Can you guys see my screen?
Not yet.
Okay.
Yes, sir.
Yep, thank you. Please remind me if you don't. Can you see it now?
Yes.
Okay, awesome. And I'm recording this, and what I do every single class is I'll get the recordings and then I'll shoot them out to you, okay, and then I'll post them online. And there are some recordings from other courses in there. If you want to go check them out, you can. I basically I go through the same stuff in all my classes because I've designed my classes a specific way. So I'll show you. So here's the just the introduction to the class. Okay, hopefully you read this because what they really wanted was to have somebody like me come and teach the class, who's an applied economist. Okay, and I look at myself as an applied real estate and financial economist. Okay, and what is it? Why would I? How do you get here? One, there's a lot of academics. There's a lot of teaching, and there's a lot of industry experience, okay, which is different, okay. Most PhD academic economists may or may not consult, okay. Definitely have to publish and peer-reviewed journal articles to keep their tenure, and then to establish themselves as experts within the field. As business economists and applied economists, we look to the theoretical economists for basically research and development ideas and techniques and tools to basically utilize their work to apply in the business context. Okay, it's application. All right, and just so you know where I came from, and I'm not going to spend too much time on it. Born and raised in Oakland, family was in the restaurant business. I was supposed to go in the restaurant business. I didn't want to go in the restaurant business. I worked in dirt parking lots at Candlestick Park through college. I had a professor who was an economist. I wanted to be like him. So I basically went and did an undergrad in econ, an undergrad in business with concentrations in real estate, finance, banking, and accounting. Then I went on and did the master's in applied economics. Then went on and did a master's in finance, a master's in political science, a master's in public administration, and a master's in information systems. And then went on and did a doctorate degree in business administration with a concentration in finance. And my doctoral dissertation was applications in modern and postmodern real estate portfolio theory. Okay. It took me 14 years to write the book. Finally published it in 2014, and they hired me here in 2015. Since then, I've been working with technology companies to basically build statistical algorithms to be able to design investment strategies for real estate securities. We designed two products, one that mimicked the underlying real estate market, and the other one was a trading arbitrage model. The tech company built that one. I provided some of the IP for the first one. So we have two institutional products that we're going to market with. COVID basically disrupted that, but hopefully we'll have that back on track. I'm also known as a real estate economist. I ran research departments one for Charles Schwab. I ran their index division. I worked for a company called BRE Properties as their director of research. Built the first institutional grade strategic research vertical within a large REIT. They ended up growing to be 2 billion, 4 billion, and I think the company's now like 22 billion in assets under management. I worked for a couple pension fund advisors, designing portfolio strategy and doing economic research for them, and also worked for a couple real estate brokerage firms, running and building their research departments for them too. Currently, I am a real estate investment broker, doing large multi-million-dollar investment transactions, and I'm also a mortgage broker on the commercial side, also putting together large multi-million-dollar financing transactions. Those two I just started within the last year. Took me a year to design the strategy, and then I got into it maybe 3 months ago. So moving away from applied academic research and industry, more towards transactions. Okay. So why don't we do that before we get going? Can you introduce yourself a little bit?
Yeah.
Maybe tell me where you're from, your major, where you work, and if you guys are looking for jobs, let me know, because part of the requirement is for you to provide me with your resume, and I'll look at the resume, I'll critique it with you. I'll be meeting with you guys maybe 1 or 2 times during the next 5 to 6 weeks. You probably want to meet with me so that I can work with you on a one-on-one basis. My methodology of teaching has been called relationship-based teaching as opposed to pure academic teaching. I get to understand who you are and how you're doing and work with you on a one-on-one basis to help consult, mentor, advise you on not only things on what you're going to get out of the class and to train you to think as an applied economist and an industry professional, but also be interested in who you are and where you're going and see how I can help you. Okay?
Okay. I'm Nadine. Let's see. I graduated from UC Berkeley.
Nice.
Psychology and anthropology.
Awesome.
And I work currently as a software engineering program manager at Square. FinTech, building hardware devices.
That's fantastic. Congratulations. That's awesome.
My name is Gabriela. I graduated in industrial engineering in 2018 in Brazil. I have been working for IBM for 3 years in Brazil too, and now I'm just studying here.
That's fantastic. Congratulations.
Thank you.
Hi, that's me. My name is Karan Najjar. I graduated recently from CSU East Bay with a business administration with a marketing focus.
Excellent.
Thank you. Right now, I'm actually presently looking for my next position.
Cool. Well, let me know. I taught at Cal State East Bay for, I think, over 4 years. Ran their real estate, taught a lot of their real estate classes. Love the diversity, love the students. They're awesome.
I'm Nirali. I graduated from St. Mary's last year, May 2020. I graduated in psychology, and my most recent employment was with Roth Corporate in HR, and right now I'm looking for new opportunities.
Awesome. So let me know. Okay.
My name is Saidana. I'm from Kyrgyzstan. It's in Central Asia. I graduated in 2007 and I majored in telecommunication. Currently I work as a software QA engineer at Arcasa Health and Human Services.
Awesome. Congratulations. It's fantastic.
My name is Jackson. My name is Jackson Hewlett, and I just graduated from St. Mary's a month ago in applied mathematics.
Nice.
And I am playing baseball for 1 more year here at St. Mary's, so that's what I'm doing.
Okay, awesome.
Yeah,
Good
no
for you.
job yet, but.
Well, let's talk strategy too. You know, I mean, I'll be going over some of the model building techniques. We will be getting in some of
Yeah, I just finished mathematical modeling in the spring of 2021. It was a really interesting course.
Yeah, so we're going to go over model building. We're not going to get into hardcore, statistics, but I'll walk you through some of the model building techniques.
Awesome.
Okay, and then with your math background, let me know how you go if you don't go pro. But even if you do go pro, you probably want to think about, you know, some fallback strategies at some point.
100%.
Yeah, okay,
I'm
so we'll
24
talk.
already.
Okay, awesome. And then, who else do we have online? I'll let you guys,
It's old for baseball players in college.
Joseph, why don't you go first?
Hello, yeah, I'm Joseph. I just graduated, class of 2021. I was in the intro program at St Mary's. If anyone doesn't know, it was just a lot of philosophy, but it was similar to this in that it was cohort style, so that's kind of cool. I just work for the school, St Mary's, helping out with the Gatorade camps over the summers, so I've not really had that much of a professional job, if you will. But I'm really enjoying what we've been learning so far in the class.
Okay, great. And I will throw out to you guys too, because of COVID last year, not only was I, you know, impaired significantly, but a lot of my students were impaired too. A lot of them lost their internships. It was a really tough time for a lot of us, and a lot of them came to me and asked me if I could help them. And at first I was thinking more trying to place them, you know, in a COVID environment, which was almost impossible. So what I decided to do was basically to hire everybody that I could and create multiple research teams with my students. We already published two articles, one on Alexander Hamilton and how he engineered the Federal Reserve. We also published an article in a peer-reviewed journal on real estate technologicalization and the application of technology in real estate and how it's going to revolutionize real estate. We're actually in copyright with Francis Taylor and Rutledge. We basically took some of the research that I did. I made some of my students editors and publishers, and they basically moved forward and found a publisher and are publishing the book. And we probably have like 3 or 4 other books that we're probably going to publish. We have 3 other articles that we've been working on for months on sustainability in real estate, infrastructure investing, data centers. Those will probably be going to publication and the market within the next probably 1 to 2 months. And there's other projects, you know, if anybody's interested in, you know, Joseph, you know, if you're interested in joining and sitting in, you know, on some of our weekly meetings as we go through, you know, the research and editorial and process of actually putting together a strategic white paper, and then taking these research papers and then coming up with a publication strategy and targeting the industry and the academic journals for publications. And then all of my students who are involved in these research projects are put as co-authors on the books and on the articles. So I basically created a virtual research publishing vertical with about 15 of my students. And I've been kind of managing that over the last, since really March of last year. So if anybody's interested, like Joseph, who may not have a lot of business experience, but could come and observe, participate, and maybe even work on some of the projects, I'll put you under my Economics Applications Inc. Corporation, and we'll help you write up basically a job description that you can put on your resume and leverage that to get another job. Okay? Or if you guys are looking for jobs, I could probably, if you're qualified and ready to go, I could probably place you in my mortgage brokerage company, maybe in my real estate investment brokerage company, or maybe in some other companies of people who have approached me and said, I need some internships, or I'm looking for somebody right now. Do you know of anybody that is looking for a position right now? And then I just, you know, refer you over, give them a call, you have the interview, I've looked at your resume, I can coach you a little bit, and then hopefully that will lead to a placement. And I love placing my students. Okay, so I'd be happy to work with you, Joseph, if you're interested in something like that. Jada?
Hi, I'm Jada. I just graduated from St. Mary's as well in 2021. I'm on the softball team here, so
Great.
I don't really work during the school year, but
Uh-huh.
during the summer, I actually just finished a startup internship for this company, Diverse VC, as a marketing intern.
That's fantastic. And for the sports people, if you're interested, St. Mary's does have a really good sports management program, so you may want to hook up with those guys, you know, and kind of tap into their network, if that's you know, an industry you want to be involved in. And I would also go tap into USF, University of San Francisco Sports Management Program. They have a LinkedIn site, a LinkedIn page. I think they have like 5,000 in the network of graduates. Well, just imagine 5,000, 50,000, 500,000, 5 million. So basically, between the LinkedIn page from USF and probably St. Mary's, you can probably get in contact with pretty much anybody and everybody who's involved in sports management on a global basis. So, you know, you might want to consider that if that's something you want to do. Kamaya, did I say that right?
Yeah, you got it.
Okay.
I just graduated from Harvard this year. I studied sociology. I'm originally from Sacramento, California. I'm also going to be on the soccer team. I'll be on a sports team. So currently I'm just part-time interning for a sustainable, environmentally friendly branded merchandise startup company.
That's fantastic. Congratulations. That's awesome. Danielle?
Hi everyone, I'm Danielle. I'm from the Bay Area, San Jose. I got my undergrad at Dominican University, which I know controversial because they're apparently rivals of St. Mary's. I know it's a joke because we suck at sports, but in 2019 I got my undergrad in history and communications, and then actually went into the sports world, and I'm currently a project coordinator at a sports company called La Garza. We do physical education, physical education camps, after school programs. So I run over from running my sites in the day, and then I run to see you guys in the evenings. So.
Awesome. Congratulations. That's fantastic. Francois?
Yeah, so I also just graduated a few months ago in environmental science from St. Mary's. I'm from South Africa, so across here with the rugby team for another year. Not really working, just a few small jobs on campus. A little bit limited by my visa, but yeah, definitely keen to look at some of those opportunities for people that don't have as much business experience, I guess.
Yeah, awesome. You know, the USF program, they do their residency in South Africa. So there might be, you know, some connections. What position do you play?
I'm a flanker.
Yeah, that was my position.
Oh yeah.
Yeah, I played 10 years, and I played with Johnny and Tim. I played with your coaches.
Yeah, hopefully that was a good thing.
Yeah, no, it was good. I played for them for 3 years, and got on the first team to tour Australia and New Zealand, and I played loose head prop, and we won 5 out of 6 of the games when we were over there. They weren't very happy. Nadine?
That was me. I went first.
Oh, you did? Okay, great. Brandon?
Yeah.
Okay, say nice things.
Yeah, I just graduated this spring. I do construction during the day and then come here to you guys. So.
No aspirations?
I don't really have any. I interned last summer, but I'm not interning this summer.
Okay, what do you want to do?
I'm not too sure right now.
Okay, let's get together and map out a plan.
Definitely.
Okay, Angelo, did you go?
No, Professor.
Okay, how you doing, Angela?
I'm doing good.
Good.
Graduated this past spring with my undergrad in communication. I'm also on the sports team here. I play rugby, so during the school year I don't really have a job, but my most recent work was I worked as a contractor at Tesla.
Oh, awesome. What position do you play?
I play lock.
Oh, that's awesome. So we have nobody from the back line here?
Oh yeah, I played backline.
Oh, you do? Okay.
Yeah. I played 12. Oh yeah, Joseph too.
Okay, awesome. Nirali?
That was me.
Okay, got it. Sedana? Got it, okay. So did I go over, has everybody gone? Okay, cool. All right, thank you for doing that, I appreciate it. And we'll get to know each other throughout this short semester, right? All right, so let's go through the, can you guys see the screen?
Yeah.
Okay.
I'm not sure if MAH went.
Huh? Was somebody snuck through? Who?
Yeah.
I didn't get it.
Oh, I'm sorry, I apologize.
Oh, it's okay. Hey everyone, I'm Neha. I graduated in business administration and with HR concentration in 2018. And then I had an opportunity to work as a senior associate HR for a year. I'm currently attending all the lectures from India, so I'm really looking forward to hopefully meet you all in person, probably by next month.
Okay, thank you. And I wish you and your family and everybody all of the best. I send all my best.
Thank you.
Okay,
Thank you.
you're welcome. All right. So can you guys see the screen? Okay, good. All right. So we went through the book. Here's the Zoom. We already know about that. Here's my background if you want to dig a little bit more. Here are some of the lectures from last semester if you're interested in taking a look, and it'll basically cover the same stuff that we've gone over. So you can fast forward to the lectures if you want to. But I just wanted to show you how I'm gonna do it. These are just, we'll go through some of the stuff later, but you might want to click on some of these now. The Organization for Economic Cooperation and Development is a great resource for statistics on government, different countries, foreign direct investment, which means, you know, people are investing in the country, gross domestic product, which is GDP, employment, poverty levels. So a lot of statistics for different types of countries. Because when we build models to be able to try to forecast where we think the economies are going to go, and if we know where the economies are going to go, we know where the stock market, the bond market, the real estate markets, you know, are going to go in these countries. So we can use a lot of the data from the OECD, the World Bank, Bank of International Settlements, the World Trade Organization, you know, all of the, you know, MSCI provides a lot of indexes, markets, iShares, which is BlackRock here on Harrison Street in San Francisco. These are all the exchange traded funds, country funds, different strategies that people want to invest in, exchange rates, let's see, Bank of International Settlements, Yahoo Finance, World Indexes, Bloomberg. These are all, you know, resources for you for people who are interested in international statistics, economic indicators that want to use these for their own modeling purposes or their own research purposes. Okay. Test question. Has COVID-19 had an effect economically on countries across the world?
Yes, I have.
Yes.
Stock markets?
Yeah.
Real estate markets?
Yeah.
Bond markets? Gold? Yeah, everything. Labor markets? Yeah. Just to kind of put this in context, usually what we do, and what I've learned over the years, is what's happening and what happened, or what's going to happen, that's similar to other events that have happened in the past. Because the markets move through cycles. We go through recessions and depressions. We will probably continue to go through recessions and depressions in the future. The question is, what is the triggering event that is going to cause that next financial crisis, or that recession, or that depression? If you go back in time, it was financial crises that created the Depression of the 30s. Roosevelt implemented fiscal policy. The Federal Reserve tried to implement monetary policy, but the severity of the Depression was so severe that monetary and fiscal policies were limited. The solution, unfortunately, was World War II. World War II basically was the triggering event that basically mobilized production, employment, and capital in the United States to spend billions of dollars to basically win World War II. The aftermath of World War II was basically an upgraded industrial economy, a industrialized economy in the United States. Unfortunately, millions of people had to die because of it, but the benefit was a mechanistic, machine, advanced industrial society, okay? And that actually occurred to a certain degree in 2011 through 13 in World War I, okay? But World War II was a whole different magnitude, okay? That basically pulled us out of the Depression. Post-World War II was a transition from basically military good production to a consumer-based economy based on world trade. With the United States basically becoming the dominant, the largest economic power on earth. Because the Soviets were not a competition at that time. China had not emerged at that point in time. Japan and Germany were completely destroyed. But through the Marshall Plan and investment by the United States into those countries created other developed economies based off of democratic capitalistic principles. Okay. Then in the 50s, we went through the volatility in the economy was very high coming out of the war, and I'll show you some statistics. And then as the Federal Reserve and as the political economy became more centrist in political ideology and policy outcomes, along with the Federal Reserve learning how to manage business cycles started to emerge over the decades. And we would fall into these mild recessions over the decades. It was actually quite elegant. And then we had events like the peso crisis in we had severe recessions in the first 5 years of the 70s. We had 2 recessions in the first 5 years of the 80s. We had a severe real estate recession between 91 and 93. In the 90s, we had the dot-com boom bust in the 2001 period. We also had the peso crisis in 95, the Thai baht crisis in 97, the Russian defaults in 98, Y2K in 2000, and the dot-com bust in 2001. We had the housing boom in 2006 and 7, and we had the housing bust and financial crisis, and the most severe crisis, economic crisis, since the Great Depression in 2008 and 2009. Okay. Man-made recession due to deregulation and corruption. On the website, I have a movie review worksheet. I will require you to watch 2 movies, fill out the worksheet. The first one by Charles Ferguson, which is The Inside Job. And if you want, you can watch The Big Short. That's a fun one. It's very similar, but you got to watch The Inside Job first to really understand the political economy that led up to the financial crisis, the corruption that occurred, the amount of money and jobs and production that was lost during that time period that we're still dealing with today. what the Federal Reserve and the fiscal policymakers did to get us out of that deep, deep recession that took us until about 2012, 2013 to get out. It was twice as deep and twice as long as any other post-World War II recession. It was that severe. And then we had basically one of the longest expansions since then, up until March of last year when COVID hit, and we went into another depression. Okay, if you look at the statistics of COVID, if you look at GDP, if you look at employment, unemployment, you look at all the economic indicators, we've never seen anything like it ever in the history of economic analysis. It's a Six Sigma event. It's outside the 2 standard deviation probabilities. And we never knew, we knew it was coming, we knew it was a probability, but there was no public policy or institutions that were developed to be able to either prevent it or to mitigate it. Okay, it was all reactionary. So it was, if you look at the statistics, and I'll show you some of the statistics, they're absolutely horrifying, what we lived through. Thank God the monetary policy makers and the fiscal policy makers were responsive enough to be able to pump the system with enough money to everybody to prevent the economy from falling into a deep, deep, deep depression. We circumvented that. So we're living through the recovery now. Unemployment rate's coming down, GDP is going up, inflation is coming back, which is a big fear. So we're waiting to see if the Federal Reserve is going to raise interest rates to quell inflation, because you as a bondholder do not like inflation, because your bond interest rates and your principal are going to be worth less if inflation continues. And then we'll see what happens. And I'll walk you through, you'll do the pre-test, which you should start working on now, and I'll walk you through the pre-test tonight. I combined the pre-test with the quiz, okay, and it's all take-home. Some of the questions on the pre-test you're not going to be able to answer, don't worry about, skip over it. A lot of the questions that you can totally answer on the pre-test through the internet and maybe some of your courses, the information's there. Make sure you put in the graphs, the diagrams, the definitions. If you can't write legibly, you have to work on your handwriting, because I want to see how it's written out. You're going to learn more by writing it out than if you're typing it or copying and pasting it or plagiarizing it from some kind of website or some other kind of content. So I'm looking for actual work, and Brandon's already done it. So maybe if his dog didn't eat his pre-test, he could probably dig it out from underneath his bed and use it again. But the last part of the quiz you're going to have to do, I basically followed the book, so it's definitional. So the quiz is basically a review of the major concepts from the book. Okay, so that's basically the first piece. And then the midterm exam is usually the quiz that I give my other classes. Okay, that really walks you through some of the key applied concepts. The book just presents you with stories. But how do you actually apply the stuff that's in the book, and how do you apply the stuff that's not in the book? That's why I'm here, okay, is to go through some of the model building, and I'll walk through that stuff in a second, through some of the model building. I'll walk you through interest rates, what are called yield curves, yield curve theory, monetary policy, fiscal policy. I'll walk you through unorthodox monetary policy, which isn't in the book. I'll walk you through portfolio theory. I'll walk you through the microeconomics and the organizational behavior of how do you as a firm approach product innovation. What are the microeconomics within the firm that needs to be met to be a successful product innovator? All of the companies, Apple, Cisco, Salesforce, you name any of the SAP, you name Siemens, you name any of the top companies, they adhere to exactly that model that I'll go over with you in class. So it's like do you guys do a capstone course?
Yeah.
At the end? So this will be a midterm capstone. for you. It'll be a review. So when you get to your capstone, you will have already gone through a capstone, so I think you'll get more out of it. Okay? But mine's more application oriented as opposed to theoretical. Okay? We'll go through portfolio theory and how you actually build a portfolio of stocks, bonds, and real estate, and what that does to your portfolio. What happens if you add alternative renewable energy or insurance to your portfolio? What does it do? Are you better off or worse off by applying these alternative assets to your portfolio strategies? We'll talk about technical analysis. How do you spot trends in data? Because that's the first thing people are going to want to do. You talk to an accounting person, a finance person, an ops person, anybody. They're going to say, well, look, show me a chart, show me the table, show me the statistics, show me the analysis, show me the trend, because I want to look at the numbers. Okay? And see if I can spot anything or understand why things happen the way they did so we can prevent it in the future or we can replicate it in the future. So it's all in the data. Okay? And the top people within these companies are data junkies. Okay? They're data junkies. They love data. They look at the data. They study the data. They come up with strategies around the data. And then there's usually people like you and me who basically work with those people, put together the strategic white papers, write up the research, bring the recommendations and the reports to the investment committee or the boards of directors. We present our research and our recommendations to the board and the investment committee. If the investment committee and the board believes that our recommendations based on research strategy is correct, they will implement the recommendations as policy. And if we're correct, we will get the raises and the bonuses and the promotions that we deserve. And if we don't, we'll go to a competitor. Okay? All right. Yes?
When you said you want to look at what's happening, what happened, and what's going to happen, what I know is a way different economy back when the Spanish flu happened, but what happened after that, similar to what happened?
Yeah, it's really, I wouldn't even use it.
Okay.
What I would do is go up here to, COVID-19 global tracker or the COVID-19, tracker map and go look at the real-time data. And then what I would have been doing is overlaying the stock market statistics on the infection rates, hospitalizations and death rates across all the countries, and see if there was correlation causation of the infection rates, hospitalization and death rates on economic activity, the stock markets, employment, all of those things. And then basically say what we would do, since you're economists now, is we would try to model it out, right? And say, okay, this is what happened this time around. What's the probability of a COVID mutation occurring where basically the Pfizer, Moderna, Johnson & Johnson vaccines basically degrade because the vaccine mutates. Now it's in, what is it called, the alpha?
The Delta.
The Delta virus now that's mutated, that's attacking people who are unvaccinated, which is a lot of people. Now you basically take those infection rates, and start to model it out and start to forecast what the economic impacts would be on countries. Okay, that's what I would be doing. And we know that a lot of countries, even in the United States, the middle of the United States right now, particularly the South, are being affected the most because they don't have access to the majority of the vaccinations and inoculations. And a lot of it has to do with racial disparity and income inequality. So if you look at actually the thematics of the infection rates, county by county or state by state, and start overlaying socioeconomics and demographics and economics and wealth distributions and concentrations, you can really see who is really being impacted. And the ability to cure those inequalities needs to come from Congress and come from the government to cure those market failures through politics. So the economics and the economic model, I look at it as is further down in the logic. Okay, it's going to start with demographics and sociology and culture, and then you have politics. Politics becomes law. Laws then administered through the bureaucracy with intended and unintended outcomes. And then you look at the outcomes associated with those policies. So if you want to address poverty, you have to look at who is in poverty and why they are in poverty. And it's probably healthcare, a lack of public good provision in healthcare, housing, and education. And if you look at the individuals who have the least amount of education, housing, and healthcare, it's minority groups. So there needs to be government interventions to be able to provide subsidies and supports and institutions to redress some of those social issues. And that costs money. And in a capitalist society, you're battling between social public goods and corporate goods. Lower taxation, economic activity, economic growth, jobs. Poverty, lack of health care, lack of education, lack of opportunity, lack of jobs. And then it's hopefully you have a well-functioning political economic system to be able to address some of those goods. We're different here. We're a democratic capitalistic system. You go to Europe, it's different. It's more socialistic. Social welfare, you know, in Denmark, Sweden, more corporatist. In France and Germany, more neoliberal ideology like the United States in the UK. So you can use politics and political science and philosophy and history, psychology, to then drill in to the economic theory and the finance theory and the accounting. I look at those at the higher level, but it's multi-institutional. The more you know about other disciplines and the interrelationships between them, you're going to be able to build better models for better forecasting. That's the problem with academics, is we're siloed into specific schools with basically like the economics people don't really do as much political science, and the philosophy majors are mostly philosophy and psychology and accounting. So we're all siloed, and what we're missing is multi-institutional analyses, multidisciplinary analysis. And when you start to do that, the answers start to come to you quicker, and then you can articulate it better. So this COVID-19 statistics, this is very telling. You know, are the trends going up or down? Is it fragmenting? And you can see that the United States is big, but again, you know, only 35% of the United States is really inoculated. So we have a significant portion of the Midwest, in the upper Midwest, that hasn't been inoculated or vaccinated. And a lot of it is because of politics. So until you address the politics, you're not going to solve the COVID issue, and you can't solve the economic issue and the poverty issue if you don't solve the COVID issues. Okay? And this is a whole new area. We've never dealt with epidemiology and viruses and health as a significant exogenous shock that has hit the system for us to be able to address, you know, and you know, address. So it's all new. So it's a new area. If you look at the COVID tracker, this is a good one too. This basically shows you the cases. So you can see a lot of the cases have been addressed in the coastal areas, but everything has moved into the interior. High rural poverty rates, lack of healthcare provision. And obviously you're going to have labor shortages in those markets too. This is interesting on a global basis. So what's the trend? Oops. They're trying to charge me. Okay. Have we been going through waves? Not as bad as Europe, where we actually had to shut down the economies, but some of the economies are starting to shut down again. Because the new variant, you've had very low vaccination rates, and the new variant is just sweeping through these countries. And the government doesn't know anything to do but just shut down. Okay? That's not the solution. Right? The solution is mass vaccination. Okay? And the vaccines are actually very durable. That's why we're here, because we've all been vaccinated. But the vaccines are very effective in being able to address some of these new mutations. The question is will there be new mutations that the new vaccinations cannot handle? Will we have to have booster shots at some point? They said no, but we don't know yet, right? We don't know how the disease will mutate. And how long do you think we'll be dealing with COVID? As an economist and the impact on the economy and the labor markets, how long do you think we'll be dealing with COVID? Yeah. Yeah, maybe
Globally,
forever.
Yeah, globally it will be a while, for sure.
Yeah, maybe forever. Okay. Yeah, which is sad, but it's the reality of it. I talked about Bloomberg. Here's The Economist. You're more than welcome to go up there. They have some great articles. You can use it. Here's my email address and my password. Same thing with Bloomberg. So I'm giving you access to my resources. Okay. Yahoo Finance. Yahoo's gotten a little dorky over the years. But if you go to the home page and you click on finance, this is what you're going to find right here. Usually what they'll do is they'll give you, like, here's all the cryptocurrencies. People were asking me tonight about crypto. Actually, I'm working on a few blockchain projects in real estate. Right now, we're hoping to launch a platform at some point, which is kind of exciting. And here you have like some major news. So I usually like to kind of scroll, see what's moving the markets, what are the major gainers, which ones are the major losers. These are the ticker symbols right here. So you can click on those, get to the stock chart, look at the history of the stock chart, how it's moved over time, and I'll show you some technical analysis on how to trade and how to analyze some of these stock charts. Maybe I can do that now, just to kind of give you an example. Let's look at AMC. Oh, no, let's look at Apple. Oh my God, look at that. Okay, can you guys see that online?
Yes, Professor.
Okay, so here's Apple stock, all right? So this is a pretty good dashboard. You got some key data here. So this is where it's trading. This is the bid is what are the offer bids by the traders. The ask is what they actually sold for. Okay. Here's the range of the stock price. Here's the 52-week average. Here's the trading volume, average trading volume. So these are all some key statistics. This is the size of the company. Apple's only 2.4 trillion in market cap. It's probably them and Google and Amazon are as big as some country economies. This is the beta right here. If the stock returns moved perfectly with the S&P 500, the beta would be 1.0. You want to write that down, okay? The returns on Apple move 1.21% with the S&P 500. So it moves 20% more, both up and down, against the S&P 500. So if the S&P 500 goes up, Apple will go up 20% higher. If it goes down, it'll go 20% lower. It's it's more volatile than the overall market index.
Okay, so basically the higher it is than one, the more volatile it is?
If it's one, it moves exactly with the index. If it's more than one, it moves more than the index. If it's less than 1, it moves with the index, but it moves less than the index. Okay? So beta is a measure of risk. Okay? And then in the pre-test, I'll go through, you'll be learning, you probably already know this, you'll be learning about variance and standard deviation, which measures volatility, which is a measure of risk. Okay? Yes?
So I have invested a little bit of money in Apple. It gives dividends. I've always wondered, like, what is a dividend? Like, does it?
Yeah, Apple gets all this money.
Yeah.
Right, through its revenues. Then it pays, all of its cost of goods sold and stuff like that. Then it pays all of its expenses, right? And then it has its earnings. It's going to take some of its earnings and it's going to retain it, okay, for investment purposes. Then it's going to pay out the rest of the cash to the shareholders as dividends. Okay? And you as a shareholder are going to be entitled to a certain dividend per share. Okay? So not only are you getting a income return from the stock through dividends, which is good, but you're also getting the stock price appreciation, which is the change in the stock price. And Apple's been, this is a one-day chart right here. If I go back, 5 years, this is what Apple stock has done in 5 years. This is what Apple stock has done since 1984. And I bought Apple stock in 95. So I bought it right there. So it didn't do anything for years. And Apple went, during this time period, Apple went from a computer, PC company to a mega media company. Apple Music, iPads, watches, iPhones. The iPhone was revolutionary, right, as a product, because it had amazing attributes. Pictures, video, internet, email, phone, social media, alarm, yeah, and then the apps exploded, right? The apps exploded. So yeah, so this is the stock chart right there. So what we can do, which I will do, is I like to go to stock charts. .com.
Professor, I have a quick question for you.
Yeah.
Will we go over the effects of cryptocurrency on the stock market?
If you want me to.
I was just curious.
Yeah, if you want me to, and we should.
Robinhood thing happening a couple of months ago.
Yeah, if you're interested, we can do some research and we'll put a little presentation together and ask the question: is there a causation or correlation between cryptocurrency prices and the stock market? Does it lead? Does it lag? Does it influence it, or not? We don't know.
I think it does. I think it absolutely does.
Well, then that's your hypothesis, and you want to test it.
Cool.
Okay. So let's look at Apple. All right. So I went up to stockcharts.com. Okay. I put in this is called a candlestick chart. Okay. Now what I do is I go up here to field chart and I go to 3 years because I want 3 years of history in the stock price. I want to do right here where it says simple moving average. I want to do a 10-day. I want to do a 30-day. And I want to do a 50-day. Okay? These are just simple moving averages. Okay? And then I'll hit update. Okay? And here's my chart. Can you guys see that?
Yeah.
Okay. Here's the chart. So if we want to analyze the chart, the trend in the data, doesn't matter what data, this just happens to be stock price data. It could be GDP, industrial production, could be employment, could be commodity prices, corn price, it doesn't matter. As you can see right here, the stock price peaked right here, right, and it bottomed right here. Okay, this is called the resistance, the peak. This is called the support right here. If you draw out the line right here across, you can see that the stock price was hitting its resistance here and hit it here, okay? But it didn't break through. So if I put a line right here, you can see the stock broke out to the upside, okay? And started in an upward movement, okay? Momentum in the stock price. Then the stock price peaked, it troughed right here. This is the new resistance, this is the support right there. And as you can see, the support right there was basically where the resistance was historically. So that's a pattern. Usually you'll see these resistances being tested, it'll break out, then the stock price will correct back to where the resistance was and form a new support.
Then what happened in the last?
In here?
Yeah.
Then something happened, right? Announcement, earnings releases, new iPhone releases, new products. They paid out a lot of dividends to their shareholders, which caused their stock price to go up. So something, you have to go back and look at the press releases and find out what happened in here. Okay. So as you can see, here's the resistance, here's the support, it broke out to the upside. Peaked, looks like it formed a support right here, looks like it formed a resistance right there, and it looks like right now it's trading in a range right there. Here's the support, there's the resistance, but it looks like it's almost ready to break out to the upside. Okay, so that's just basic technical analysis. But what I made you do is I made you do the 30, the 10, the 30, and the 50, okay, for a reason. And this is a pretty foolproof trading strategy. So you have the 10-day moving average here. So you just take the last 10 days, calculate the average. Average, 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 so it's on a 10-day. So it's more sensitive, right? Because it's a shorter time period. So the 10-day is in blue, the 30-day is in red, and the 50-day is in green, okay? So the 50-day moves slow, but the 10-day moves quicker, and the 30-day is a little bit more responsive. So here's the trading strategy. So this could be theoretically conceived as a microeconomic strategy, okay? Because you're just looking at the charts and the data. We're not doing economic theory. We're just using chart patterns, okay? So here you can see the 10-day is above the 50-day right here. Okay, so that's where you would have bought the stock. Okay, and you can see that the 30-day is also above the 50-day, so you would hold the stock. Then all of a sudden the 10-day crosses the 50-day. That's your sell alert. Okay, alert that something's happening to the stock. Okay, and then the 30-day crosses the 50. That's your sell signal. So you sell it right there. So you bought it at, I don't know, 50 and you sold it at, let's say, 60. Did you make money? Yeah, okay. Then the 10 and the 30 are still below the 50. All of a sudden the 10 crosses the 50 here, which is your buy alert, and then your buy signal is right there. So you bought the stock at 40. The 10-day crossed the 50 here, and then the 30 you sold it at 50. Did you make any money? Yep. And then it looks like here, you sold it here, you bought it back here. Right here's your buy alert, there's your buy signal right there. So then you bought it, the 10 and the 30 continue to be above the 50. So you bought it at, let's see, you bought it at 50, and it looks like you sold it at 75. Did you make any money? Yep. So then it crossed here, you sold it there, you bought it back here, you bought it at 70, and it looks like the 10, the 30 crossed here, so you sold it at 110, and then you bought it back at like 110, sold it at 130. Looks like you bought it back at 130, and it looks like the 10 crossed the 50, and the 30 looks like it just crossed the 50. So you'd be buying it now. Okay. So this is a 10, 30, 50-day moving average crossover system. It's pretty foolproof. So what you do is you pick your stocks. You don't do a lot of trades, right? You're not doing a lot of trading, but when you do trade, it's accurate, right? You can trade in a brokerage account, all right? And if you incur capital gains, you're gonna have to pay taxes, okay? I bought it for 50, I sold it for 70, I'm gonna have to pay the capital gains on the 20, okay? But if you set up a self-directed IRA, and you put money in your retirement account, you can trade all day long and not pay any taxes until you take the money out at 59 and a half. So you can trade for free for decades. If you don't need the money, you trade in these accounts, in the qualified self-directed IRA accounts, tax deferred. Okay, somebody had a question.
Yeah, I have a question. I heard if you like earn doing like a certain amount of money in the stock market, you don't have to pay taxes on it, or no?
No, you have to pay taxes.
There's some loss you can take, but it doesn't really.
Yeah, the losses are only 3,000.
Yeah.
So it's nothing. So you can trade in your stock brokerage account, but you're gonna have to pay the capital gains. If you trade within your retirement account, you don't pay any capital gains until you pull the money out when you retire, and you're not gonna pay capital gains, you're gonna pay income tax. So whatever you pull out, it's gonna go to your income, you're gonna pay the tax at your income level.
I will say the hardest lesson I learned was if you get RSUs at a company, the moment you get them, you pay taxes on them
Correct.
because you own them, even if you never sell them.
That's correct. Yeah, I made some good money on stock options with my real estate company that I worked with, but when I exercised the options, I had to pay the taxes.
Even if you don't, if you just get them, you have to pay the taxes.
And that's even worse because you got to come up with the money. If you don't have the money, well, what was worst is during the 2001, 2003 time period, people got their stock grants, and then the stock prices fell. But the IRS said that you still owe the taxes at the appreciated stock price. So those people were totally, that was an awful situation for them.
Yeah.
Okay. All right. So let's go back to the website. Okay. Where? Okay, I'm gonna go back in. Can you guys see my can you see my okay. And just confirm that you can see the course website.
Yes, sir.
Okay, can you see the course website?
Yep.
Okay. Okay, good. All right. All right, so that's a good one. Big Charts is another place that you can go to get information. So here are some of the major news. Here you can put the ticker in and you can basically build your own chart. So this is another good source of information. Seeking Alpha. I get probably a dozen feeds from these guys every morning, just to give me an update, you know, on what's moving in the markets and stuff. I don't have time to read all the articles, but you can go up and use this dashboard to quickly take a look at what's going on in the markets, and then some of the headline news. And then if you scroll down, there's a bunch of other information on the markets that you can read up on. I don't know if Seeking Alpha is free, but it used to be free where they would send you stuff to your email box and then clog your email box. But it's a good source, very high quality analysis. Okay. All right. Stock charts. Here's some old lectures if you're interested. We'll probably at the end of the class do some problems, some financial economics on, you know, how to value and make investment decisions. So I'll walk you through some of the mathematics. Have you guys taken your finance class yet? No? Okay, some of you haven't, some of you have. I'll do like a little review of the discounted cash flow and some valuation methods and how you make investment decisions. The last class I took, the students really appreciated it. So I'll do some of that too. And then, you know, always have your calculator, you know, ready to punch in some numbers. Okay. These are some examples for the different calculators. Here's the product innovation lecture. These are the notes that you can use. Here's the supply analysis, supply and demand analysis that we're going to do on the major asset classes. Those are the notes. I basically lectured in some other classes, wrote notes on the board, took pictures of it and posted it up there for you. So you can take a look at it. Here's some other class notes, pictures, some midterm question notes. Anybody interested in a career in financial services? Become a wealth advisor, investment banker, broker, a trader, anything like that? Yep. So to be able to trade securities, like this was another job I just got. I just got hired as a sales and research person for a company called Pensera right here in Orinda. I don't know if you guys have heard it. They have an investment banking unit, a trading unit. They basically manage $7 billion on behalf of their high net worth and institutional clients. So I'll be working for them. To go work for these guys, I had to take the SIE exam through FINRA, the Securities Regulatory Agency. You can't just sell real estate or insurance or stocks and bonds and option contracts. You have to be licensed to be able to do it, so you have to pass the exam. This is the first level exam. Okay, you pass this, you're almost guaranteed a job somewhere in an advisory firm. You could go to Merrill Lynch, Morgan Stanley, JP Morgan, Schwab. You know, you could go work for a registered independent, you know, investment advisor if you want to. You could become one if you want to. They apply a lot of the economic theories that I've laid out, a lot of the stuff that I talked about tonight. They invest their own money and they invest on behalf of their clients. They do financial plans. They sell financial products to their clients. And if you get enough assets under management, you sell enough products, you can actually make a really good living on it. So a lot of people really like to do it. Okay. If you're interested in that, let me know. Okay. Here's the syllabus. Let me just cruise through the website. So here's the syllabus. Here's the pre-test. Okay. Here are some pre-test notes. Here's right here. Can you guys see this? Yeah. Okay. This one. This one right here there. There is some supplemental materials that I included in there that will help you be able to fill out the statistics section of the pretest. Okay? So I'm trying to like spoon feed you as much as I can to make things as easy as possible, so that you're not wasting your time looking around for the answers. You know where the answers are, so you're learning more. You're not wasting time looking for stuff. You already know where to go get it, so that learn the material. So you're spending more time learning the material as opposed to finding it. Okay, is my theory. Okay. So there's that. Here's the calculator stuff. If anybody's interested in trading games where you want to kind of cut your teeth on simulated trades, I have at least a dozen trading games, option contracts, stocks, whatever you want to do. You can go in, set up a fictitious account and start trading the account to see how you do. Okay, and here's the midterm right here. And we usually don't have a final. I don't know, do you guys want a final?
We're good.
Okay. Do you guys would you guys like a 150 question multiple choice midterm exam? Or do you want me to go over the exam, you guys take notes and submit the notes?
Second option sounds great.
Okay. I just double checking because I usually get one or two students that want multiple choice exams for some crazy reason. Okay. So here, course description, goals, objectives. The way that I usually teach my classes is you guys all start off with an A, okay? And then you just try to maintain it, okay? Work with me if you guys have any problems with anything. You got school problems, you got relationship problems, you got anything problems, just let me know, and we'll work through it, okay? If it's overwhelming, the content's too hard or there's too much, just let me know, okay? I'll totally accommodate you. Last semester, I only had one student that didn't finish the class, but I still gave her an A, and I gave her 2 months to finish the class, okay? Because she's a good student. She just, for some reason it didn't work out for her. I gave her the benefit of the doubt, and we're working together to remediate it. She'll get an A, and she'll be able to get through her program, which is awesome. And then I had 2 other students last semester in my undergrad that just forgot to upload the material. So I gave them a B. And it's like, that's crazy. You had the material, you could have uploaded it, gotten the A, but you chose to blow me off and get a B. I said, hey, I'll tell you what, you can finish up, upload it, tell me when you uploaded it, I'll go over it with you, and if you want an A, I'll give you an A, I'll talk to the registrar's office, since you did all the material and you did an A work, I'll still give you the A. So you really got to blow it to really not get an A in my class. You got to do the work, but I'm kind of setting you up for success, okay? And don't tell any of the other professors that I'm this nice. Okay, so again, syllabus, pre-test, supplemental material, exams. Here's some yield curve stuff. We're going to spend a lot of time on that. Grading policy. Here's the books again. Oh, here's what I think is really cool. And for some of you who don't have a book, what I did was I put in the teaching guides. So basically the instructor notes. So you can read those if you want to. Then you have the solutions to the homeworks. Okay, I assigned you the homeworks, but I also gave you the solutions. So that's all you got to do is read the question, read the solution, write out the answer, study from that, learn the right stuff. Okay, so you're not wasting time searching around to try to find the answers. I'm giving you the answers, you write them up, study from them, learn the material. Okay, that's all I'm asking. Okay, and then you have the PowerPoint presentations. Okay, so they're the PowerPoint presentations, they already have the notes in them. So when you come next week to do your presentations, study them. You can even edit the PowerPoint presentation down if you want to just focus on the 12 to no more than 20 minutes, 12 to 20 minutes. Because you're going to lose the audience, right? You focus in on the key concepts taken from the PowerPoint presentation. You work with your group. You basically, division of labor, who's going to cover what, and you move through the material, okay? And then they have the notes at the bottom of every slide. So if you get stuck or you didn't do it for some reason, you can just slow it down, read the material, walk us through your slides.
So just so I'm clear, next week we're given a presentation.
Yeah, you want to do your 2 chapters.
Based on the assignment. Okay.
Yeah, and then we'll see how that goes, and then I'll assign some more. So I'll do my lectures, and you guys can do the PowerPoints. How's that sound? And then I'll co-teach with you too. Go ahead.
Is it 12 minutes per chapter or 12 minutes total for the?
You know, I would say a minimum of 12. Usually most students go longer than that. But, you know, I'll leave it up to you guys.
But I'm saying like per chapter or for the whole presentation? So
well, it's each PowerPoint is one chapter.
Okay, but like...
yeah, 12 to 20 for each chapter.
Okay.
Yeah.
So like a total of 30 to 40 minutes of presentations? Because if you assign 2 chapters?
Yeah.
Okay.
Yeah. And you know, not everybody's going to present, and you know, I'll probably push it off and stuff. So I'm pretty accommodative. You know, just be ready to do it. We'll just do one, you know, next week. See how we do, because it usually takes a couple sessions to ramp up, because I got to still train you in the economics. And then we'll do like an hour, you know, maybe an hour and a half of PowerPoints, because, you know, at some point, PowerPoint's just, you know, you go brain dead.
Yeah.
Okay, go ahead.
Wait, also for the recommended calculator, so for that, do we have to use that one, or can we?
No, you could use any one you want. Just when I do the problems at the end of the class, for the final, I'm going to do, like, I'll go through a capital budgeting valuation problem for you. Bring your calculator so that you're doing the calculations with me. Because I'll go through the problem, you'll be doing the calculations, so you're learning how to do the calculations. Okay? Does this all sound okay? Okay. And then there's your resources, right there. I will require that you do a market memo, starting with the stock market. Okay, and I'll show you, I have some templates for you, so you don't have to do the formatting, but I'll show you what they're like. And I want you to make an attempt at one of the memos and bring it next week. Okay? All right, and then once I sign off on the memos, then you can start doing the rest of the markets. You'll do oil, gold, and we'll see if you can do, you know, bonds and currency. We'll do as many as we can, but you guys need to learn how to do these market memos, because it teaches you the economics, the trading, the data analysis, and it also meets a requirement, because I hear a lot that, you know, writing. A lot of my students aren't prepared for the email and the brief memos, you know, or emails that they need to write to either clients or other people, and that communications. I know. Do you take communications with Mary Alice, or do you take a business writing class? No, they assume that you know how to write really well business-wise when you come into the program and when you leave. Is that the assumption?
Like workshops that they do.
Huh?
I think there's workshops throughout the program.
Okay. Okay. I just would not discount the importance of the writing and the communications, the PowerPoint presentations and the presentations. Because that's the stuff they're going to pay you for. They're not going to pay you to take exams and stuff. They're going to pay you to do research, to write reports, to write memos, to write emails, to do presentations in front of an investment committee or a client, you know, or a board of directors or senior level executives. That's what they're going to pay you for. Okay? So practice. So there's some writing resources here if you want to utilize them. I would say focus on your writing, get it as good as you can, and try to write business quality level, okay, business communications. Because it's not the same as English writing. Business writing is very concise. It's an active voice. It's present or future tense. It's not passive, and it's not past tense, okay? So you need to kind of write down some of those guidelines. And then for people who are still uncomfortable, there's a video on macroeconomics, monetary policy. There's Robert Shiller, Nobel Prize. Review of statistics, probability statistics, regression, if anybody's interested in learning more about econometrics, economic forecasting, how do you actually take these theories and build models to basically try to predict where things are going to go in the future and measure influences, to kind of get into, you know, the quant side of it. So these are review videos on regression, calculus, matrix algebra. This is all review for you. Time series forecasting, econometrics, computational finance, quantitative finance, financial econometrics. These are all, you know, people who are getting hired by Wall Street. They're physics majors, PhDs in physics and mathematics, you know, in quant, and going to work for Wall Street to program the models, to basically do the portfolio models, the risk management models, the trading models, the economic forecast models. Those are the people that are getting hired to do that kind of stuff. Okay. And with an econ or finance exposure with some programming experience, there's no reason why you can't, you know, move into that area if you're interested. A review of discounted cash flow, some financial accounting, financial ratio analysis. And, you know, you might want to go ahead and copy some of these links if they're going to maybe be helpful for some of your other classes. Okay, here's some licensing and certifications. If you're interested in financial licensing, real estate licensing, insurance licensing, let me know and I can walk you through it. Here is an area right here where you can find some links to the inside job. You probably can get it off Netflix. I think the library, if you talk to Sarah Vettel, she might be able to get you free access to a bunch of these movies. You can do, I would do Inside Job first. Money for Nothing's pretty good. Big Short's pretty good. These are all basically movies that I found that basically talked about the financial crisis. What led up to it, what happened, what were the consequences, you know, socially, culturally, economically, and financially for a lot of people. Okay. And it was a major event. So, and then if anybody's interested in listening to some of the Federal Reserve chair people, these are people who actually make monetary policy. Alan Greenspan, Paul Volcker, before he passed away. And then if anybody's interested in hedge funds are private companies, private financial institutions. You have to be a qualified or accredited investor, so you get a high net worth. Institutions such as pension funds and endowments invest in these hedge funds and these hedge fund managers. You don't know anything about these guys and what they do because they're basically a shadow bank, a private bank, or a private financial institution. They're big in New York. They have billions of dollars in assets under management for a lot of institutions and high net worth individuals. I found a guy, Kyle Bass, who was a hedge fund manager that made $250 million shorting the housing market in the financial crisis of 08-09. He raised billions of dollars for his hedge fund. He's a macro economist, a macro factor guy that looks at macro trends, macroeconomic trends, particularly in Asia. And his recommendation was to short the Japanese bonds and the Chinese bonds. But the Chinese and the Japanese central banks and fiscal policy makers basically stimulated the economy and printed so much money and bought the bonds and the equities in the marketplaces and caused the bond prices and the stock prices to just go up. And he had put shorts on those positions, so he lost a ton of money. And basically he shut down his hedge fund about 6 months ago, because all of his clients basically said, "You've been losing my money, I'm done, we're done." And he, unfortunately too, he hooked up with Steve Bannon. I don't know if you guys know Steve Bannon, the communications guy for the Trump administration, who basically built Breitbart News, which was the alt-right, basically news network. He hooked up with him. I don't think his clients like that either. So he's gone. But he's a brilliant person. If you listen to his lectures, he ties together economics, finance, psychology, sociology, politics, epidemiology, medicine. It's pretty amazing when you talk to him. I mean, when you listen to him. The way that he ties together multi-disciplines to basically come up with coherent investment strategies for his clients. So just incredible stuff. Here's the movie review worksheet. So you're going to want to print that out, and you can type it out if you want to. That's why I put it in Word. But pick 2 movies. You can even watch them together. Pick 2 movies, type them up, submit 2. Okay. Inside job should be one of them. All right. And here's a lecture. I think that's the one I'm going to do on tomorrow. Here are the memo requirements. So I have 2 memo videos that you probably want to review, and I'll go over them quickly tonight. I also provided you with some stock memos. Okay, some examples. So it looks like these are in Word, so just do the stock market first. And then let me look at what you did, and then I can give you some feedback. We'll clean it up. Okay, let me. That's not working. Try that one. Can you guys see the desktop?
Yes, sir.
Okay. So this is exactly how your memo should look. Okay. 1-inch margins. Okay. 16-point bold capitalized. Date to from RE, colons, indent, flush, date to me from you. And then basically this is the template. Once you get the stock template down, you can replicate it against oil, gold, and you can even take some of the factors and some of the data, maybe some of the graphs, and bring them into the other memos to leverage if it supports your thesis. Okay. So stock prices forecast to rise 7% over the next 3 months. So right off the bat, you know what you're forecasting, what direction it's going to go, by how much, over what period of time. So in business, just tell me. Don't lead up to it. Just tell me. So right there, I know what your forecast is by how much and over what period of time. So if it's oil prices forecast to rise 3% over the next 3 months, gold prices forecast to drop 3% over the next. So the structure of the sentences are the same. You're just swapping out the asset class. Okay? This is all the same too. We are tracking stock prices. Could be oil, could be gold, could be bonds, right? Based on our research, we forecast stock prices to rise 7% over the next 3 months based on the following factors. low unemployment rates. Does that make sense? Yep. Low interest rates. Yep. And higher earnings per share. Yep. These are all economic factors that basically support your forecast and its direction in less degree by the magnitude. So what I would use for stocks, since they're highly volatile compared to the other asset classes, is I would use 5 to 10%. Stocks can move between 5 and 10% over a 3-month period. Okay, that's the probability range. Okay. For oil, I would probably use, 3 to 4% in there. For gold, I would probably do the same. For bond prices, I would probably do the same. And then for foreign currency or the US dollar, I would do the same too.
Wait, how much did you say it was?
Stocks, you can do 5 to 10. And for the other asset classes, I would do like 3 to 4. Something's got to really move the market if it's going to be 5%. So the other asset classes are less volatile than stocks are. Okay? So your real challenge is to kind of set the range, but really to determine the direction. Okay? So we got this. Therefore, we recommend the following 36 trades. Some students like to say I. Here, well, we don't care about I. You're not in it with I. It's we. We're working together. We work in a team. So when you're presenting, you want to talk about us. Okay, this is the research we did. This is our recommendation. Okay, not my recommendation, our recommendation, because we did the research together. So you're giving credibility to your team. So this is the table here. Okay, this is a really good table. It's nice and compact. These are the indexes. So these are the stock indexes. We found 3. The Dow Jones Industrial Average, the S&P 500, and the NASDAQ. Okay. There might be the Russell 2000 or the New York, you might have other indexes, but these are the major 3. Okay. These indexes do not have tickers, so we just do abbreviations. Okay. The tickers here are right justified within this cell, and the tickers are left justified within the cell. Okay, so the formatting is really, really precise. Okay, most students are like, well, he didn't even read our stuff. He focused on the formatting. Well, I'll tell you, if you're doing a presentation and you submit 5 of these things or 50 of these to a senior managing partner in a firm, and your formatting's messed up, he's not going to read it, or she won't read it. It's got to look good. Okay, they look at and to see if you have any errors in the grammar in the formatting first. If there's grammar, formatting, or spelling errors in the context, there's probably errors in the analysis. That's how they check you. So here are the indexes. You're trading 3 of them. Okay, exchange traded funds, 3 of them, and you're trading 5 stocks. Okay, these are bolded, spaces here. I check these really quickly for attention to detail. Okay, there's 4 trades for the indexes when the prices are going to go up. Okay, you're doing 3 ETFs and 3 trades for the exchange traded funds. Exchange traded funds are basically a portfolio of stocks based on some strategy, investment strategy, where the portfolio trades as a single share on an exchange. Okay, so basically the movement in the exchange traded fund share price is based on the underlying value and movements of the constituent stocks within the portfolio strategy. Okay. Now, BlackRock, who's like multi-trillion dollars in assets under management, 4th and Howard Street, used to be Barclays Global Advisors. BlackRock bought Barclays and invented the exchange traded fund, which has revolutionized the marketplace for retail investors like yourself to be able to participate in the stock market based on investment strategies, and to be able to buy shares in these strategies, and these shares trade on the exchanges, okay, in continuous time. Not like mutual funds. Mutual funds are the same concept. You have this portfolio strategy, but under the SEC 40s Act rule basically states that the mutual fund share is marked to market at the end of every day. So instead of your share being priced second by second on the exchange, it's marked to market at the end of every day. So it lacks liquidity. Okay? It lacks real-time pricing. So the ETF basically is a major competition for the mutual funds. People still invest in them, but more people now are investing in exchange-traded funds. Okay? And then you have these exchange-traded funds, right here, these tickers. Each exchange-traded fund has a ticker because the shares trade on an exchange. Okay? So this is basically like the social security number for the stuff. They're very brief tickers. Okay? So you can go into Yahoo Finance or Big Charts or whatever, you can put in the ticker and the information on that exchange-traded fund is going to come up. So what you can do is you can pick your indexes, okay? Type in Google, give me exchange-traded funds for the S&P 500. And a bunch of exchange-traded funds are going to come up. That's all you got to do is just put in some exchange-traded funds. So there's a little research there. What you can do is you can pick one exchange-traded fund, let's say that mimics the S&P 500 index. Click on the fact sheet. There's like in the website, there's like a fact sheet. Click on it, or maybe in the website, it's going to give you the major holdings in that exchange-traded fund with the tickers. And then you put 5 of the tickers right here. So as you can see, she had Apple, Google, I don't know who these other ones are. Looks like she had the New York Stock Exchange, which is a publicly traded company. She put that ticker into. So this is where the research comes in. Okay? Again, right justified within the cells. Got it. The trades. There's only 2 sets of trades. Okay? When the prices go up and when the prices go down. When the prices go up, you use these trades. Exactly these trades. Okay? When the prices go down, I'll show you the other trades. And then I'll walk you through later what these individual trades are and how they work. Okay? So in the book, they talk about finance and financial instruments and stuff like that later on in the book. I bring it forward because it's application. Okay? So we are forecasting the stock market indexes to go up. Okay? Now, if I'm an institutional investor, CalPERS, CalSTRS, JP Morgan, Goldman Sachs, whoever, and I think that the stock market is going to go up based on these indexes, I can basically buy forward contracts based on these indexes and profit. I don't have to buy the shares in the indexes. I can just buy a forward contract that's been written on one of these indexes. So if somebody thinks that the market's going to go down, they're going to write a forward contract. I think they're going to go up. So somebody writes one, and I buy one. And if the market goes up, I profit. Okay. I can also buy futures contracts. Okay. Again, same concept. The futures contracts are based off of the indexes. And if I buy futures contracts and the prices go up, I profit. So it's a trading strategy. These are called derivative contracts. People use derivative contracts to leverage their capital. So if you're really good economists, and you can forecast where you think the stock market's going to go, and you think it's going to go up 7% over the next 3 months, I can buy forwards, I can buy futures contracts, I can buy calls on futures contracts, and I can write puts on futures contracts. And if I'm trading 3 indexes, and I have 4 trades, I got four total trades on the indexes, that I can advise my clients that these are the 12 things that you should do to make money. Or I call upstairs to the proprietary trading unit upstairs based on our research. We think the stock market's going to go up 7% over the next 3 months. We think that you should deploy these derivative trades to basically profit from the rise in the stock prices. Okay. It's huge. The derivative market on a global basis is in hundreds of thousands of trillions. It's the biggest global financial market. It's in the multi-trillions in notional value. So it's huge. Exchange traded funds. I can buy these shares. I can either buy them. Okay, I can buy the shares. So if I got $100,000, I can buy $100,000 of the exchange traded fund shares. But what I can do too is I can take that $100,000, go to the broker dealer, say, will you lend me $100,000? Because I think we're right in our forecast. So lend me $100,000. I'll pay you 9%, but now I can buy $200,000 worth of the exchange traded funds. So now I can buy double. And if the market does go up, leverage, my return on equity goes up exponentially because I'm using borrowed money, just like you do when you buy a house. But if the stock market goes down, my leverage curve goes down exponentially too. So if I'm right, if you're right in your forecast, and we buy on margin, and the stock market goes up, we're going to make a lot of money. Because we can buy more because we borrowed the money. We're leveraging our equity. We can also buy call options. Same thing. I can take $100,000 and turn it into $10 million by using option contracts. If I'm wrong, I lose my $100,000. If I'm right, I can make $10 million. So people like to use option contracts to leverage their capital. And if they're right, if we have good economists that are really good at doing their forecasting, we can make a lot of money. We can also write put options. Put options are usually what you buy when you think the market's going down. So I would buy them if I think the prices are going to fall, but I would write them if I think prices are going to go up. So these are the 3 trades we can deploy on these 3 ETFs. So I got a total of 9 trades. And we're also trading 5 stocks. And we can buy them on margin and buy calls and write puts on those too. And 5 times 3 is 15. So I got 36 trades that I can call my clients on and say, based on our research, we think the stock market's going up 7% over the next 3 months. Here's our trade recommendations. We have 36 for you. And if you're right, they love you. Right? They're going to give you their money. The more money you manage, the more fees you're going to make, the richer you're going to be. Go ahead.
What's the liquidity look like with those call options and stuff like that?
They're highly liquid.
Okay.
Yeah, especially when you're buying the options on these major ETFs and the major companies. Yeah, the Chicago Mercantile Exchange, or the CME, is one of the largest options exchange. Okay. The forward contracts, I'll go through it later. These are over the counter. These are only available to large institutions, financial institutions. But all of these other ones are all available to you as retail investors. Okay? And if you're right, you win. If you're wrong, you lose. It's like life. Right? Okay, so this is a really good table. A lot of information here. Yeah, go ahead.
Also, with those call options, are those taxable because you're forced to sell them?
Yeah, the institutions don't pay taxes. Okay. So they're institutions. But you as a retail investor, if you profit on any of those trades, yeah, you're going to have to pay taxes. Okay? All right. So then that's like the first part of it. Then here's your evidence. Right? Here's your data and analysis. So usually you have 3 bullets. 2 to 3 sentences max. Okay? And then what I'll do is I'll go through these with you to clean them up, to get them, so that they're really concise. So the number of Americans filing for unemployment benefits fell by 4,000 to 259,000 within the past week. Bam, we bolded the data because we're data junkies, right? Initial jobless claims in the United States averaged 358.92 thousand. That's probably bad. driving stock prices up, you don't need the. Okay? The Federal Reserve cut its target for a key short-term interest rate to a record low range of 0 to 0.25%, comma, from the previous 1%, and vowed to maintain exceptionally low interest rates. That's pretty good grammar, right? So I'm looking for grammar, okay? Conjunction, subject-verb agreements, very concise, taking out wordy stuff, some stuff you just don't need, you just pluck it, you make it more dramatic. Over the next 5 years, Apple Inc. is expecting to grow earnings at an average annual rate of 8.68%, while expecting the growth within the next 3 months to be at 7.48%. All of these factors here supports your factors, which supports your direction, which leads to your trades. And then you have probably, here's the Apple chart, and here's the prediction of the stock market growth. So these are your graphics, your technical analysis. Here's your supporting evidence that supports it. Okay, ties it all together. And then at the bottom, this last paragraph is very simple. You basically take the introduction paragraph, copy it and paste it here, change following to above, and the semicolon to a period. Now, why would I repeat that at the end of the memo? Why would I repeat the thesis?
Just make sure the person doesn't have to reread it.
Exactly. Yeah. So you opened up with this. Now I got their attention. I basically told them the solution, supported my solution, and then hit them again between the eyes and sold them to get them to take action, based on our recommendations. Okay. So that's basically the thesis. And then once you get, the first template, and then you can do oil, right? You can do gold. Now here, looks like Camille, what she did was she was forecasting gold prices were going to fall, or drop 6%. So these are the trades that you use when prices fall. So there's it's binary, 2 sets of trades, one set when they go up, one set when they go down, that's it. And they're exactly the same. So here you're writing forwards, writing futures, writing calls on futures, buying puts on futures, selling short. Okay, so if I think a stock is going to fall in price, I can sell it short, which basically means somebody comes to me and says, I think the stock price is going to go up. Well, I think the stock price is going to go down. Well, I think the stock price is going to go up. Well, great. I will lend you the shares. You give me the market price. I will lend you the shares. And then when the stock price goes down and you cry foul because you're losing money, I will buy it back for you at a lower price. So it's a way to sell high and buy low. Because I don't want to sell Apple, right? I don't want to give it up. So what I can do is somebody thinks Apple stock's going to go down, I can sell it short. So I lend them the shares, they give me the money at that price, and then when they say I'm done, you can have your shares back. It's like, great, I'll buy them back at the cheaper. So I can make money. It doesn't matter if stock prices go up and down, I can make money, if they go up or down, if I'm right. I'm going to write calls, and I'm going to buy puts. These trades here are exactly the same as these. Okay, 3, 3, 5, 12, 9, 15, 36, all the same. 2 sets of trades. You can use some of the same factors in some of the other memos that they make economic sense. The structure, the format is all the same. The bullets could theoretically be the same, but they may be slightly different because of the asset class is different. You got your technical charts here. I would use big charts or stock charts as your charts because they're uniform, and your charts need to be the same height, same width with each other, a little space here, so it looks beautiful, right? So when the person gets the memo, they're not looking at the formatting, they're looking at the analysis, the content, the recommendation, how they're going to make money. Okay. Are you guys online getting this?
Yep.
Okay, cool. So what I would do is do, I think on the website, I believe, oh shit, I thought I added, let's see, this is, for some reason it's not coming. I'll send you guys some memos. I'll send you guys some memos.
Oh, thank you.
So you have the templates. So you're not, getting bogged down on the formatting. Okay. Maybe you can send me an email just to remind me so I can send it out to everybody. Okay, awesome. So those are the memos. That's your first application. Let's see. And then I don't think, because this is such a short class, that I'm going to be able to do the stock valuation. Usually what I do is we pick a bank and we do a stock market valuation in a deck. You may want to take a look at these decks. I'll go through it with you so that you can just see, what we did and how we did it, and what we do in some of the other classes. This class is too short to do it. So the goal is at the end of the class, you've worked through the exams, you're trained in application, you get the memos down in the application, and then you do an application evaluation on a bank. Okay? But I'll walk you through it. Okay, so at least you learn it. Okay? Or you won't be graded on it. All right. So how are we doing on time?
Probably about an hour.
Yeah, I don't think I'm going to be able to last. So let's go through the pre-test real quick, so I can walk you through that. And then I think that's all I'll be able to do. Because once I lose my voice, that's it. Okay, so let me pull it up. Now, the pre-test, I started doing these pre-tests years ago, really in honor of my old econ professor, Betty Blecka, who was a brilliant econometrician at San Francisco State. She passed away at least 10 years ago. But she was brilliant, and she would always give out a pre-test. Okay, actually she graded it. It was really scary, but it was brilliant, right? Because what she was really doing with the pre-test was really focusing on content that was relevant and important, okay, as a foundation to then move forward in the class so you had a solid foundation, okay? So here we go. All right. So over here. So basically the pre-test is a, how do I say it, like a statistical foundation to review your statistics. Because economics is, not only economics is theory, but economics is data. Okay, and we're always constantly trying to find data to build models, to make forecasts, to make investment decisions or business decisions, okay? So the pre-test hits on a lot of stuff that's in the book, but is really foundational. So the first is really the law of large numbers. Why do we want a lot of data, particularly data that's normalized.
It paints the most accurate picture.
Yeah, and then what happens when we have a bunch of, let's say, percentage changes, and we have 1,000, data points, or 100 data points, or even as little as 20 data points, what does the distribution of the data look like?
Hopefully normal.
We can
Yeah.
use defined patterns.
It becomes normal, okay? It's a normally distributed data set, okay? And that's what we focus on, okay? We're looking for large data sets that have been standardized and are normal, okay? Now, why would we want to get to normally distributed data sets?
It's easier to predict.
Yeah, we can predict the mean, the average, okay? And if we have the data set and it's not normal, okay, but it's somewhat normal, can I calculate a standard deviation from the distribution?
Yeah.
Yeah. Can I calculate 2 standard deviations? Yeah. And under the theory, what the data falls within 2 standard deviations, what percentage of the time?
95.
Yeah, like 95% of the time, the majority of the data is going to be within 2 standard deviations, okay? So if I'm getting data that has data outside the 2 standard deviations, what's that called?
An outlier.
They're called outliers, right? Do we want outliers in our data set?
No.
No. Can I do a 2 standard deviation filtering process and get rid of the outliers and recalculate the mean? And would that be more accurate? Yeah, because those outliers probably are extraneous events or they're errors in the data. Do people make mistakes in their accounting and economic data? Yeah, you're going to get errors. So if I have large data sets, I get normally distributed data sets, and then I can calculate the standard deviations, filter it out, and recalculate, get the mean, and that makes it easier for us to make forecasts. Okay? Now, do we want to be accurate in our forecasts? If you're accurate in forecasting and your recommendation, what's going to happen to you, for you? Yeah, you're going to be successful. Yeah, we did the research, we collected the data, we looked at the models, we built the model, we ran the regressions, we filtered out the bad data, we ran the regressions, we forecasted, we were right. Every single time. We update the data, we update the models constantly. They're continuing to be right constantly. We can forecast not only sales, but we can forecast demand for our product. And we know exactly how many chips we need to produce in China and Wuhan to basically import to meet the demand over the next 8 quarters. Do you think people at Apple do that? Yeah, absolutely. Okay, so that's really important. Arithmetic mean, that's easy, right? It's just the average. What's the problem with the arithmetic mean?
The shifts?
Yeah, what we just talked about it. What's the problem with just taking straight averages?
Outliers.
Outliers. Yeah, they're going to skew the distribution. So it's a good, easy calculation. It's logical, but you got problems. The geometric mean is a little bit more accurate. Okay, and we use geometric means in return reporting in finance. Okay, so geometric means more accurate. Okay, and you want to show the equations. Give me the definition and show the equation. Show me a normal distribution. Show me an exponential distribution. Show me a binomial distribution. Show me a skewed distribution. Okay. Now, let's say I work at B of A and we're trying to forecast the probability of loss in our mortgage portfolio. Do you think it would be important to understand what the data distribution is before you start applying the statistics to get the information to make decisions? Yeah. And I don't know if you guys, I don't know in your stats class if you do any simulation, Monte Carlo simulations. Yeah, in the Monte Carlo simulation application, usually one of the first things they ask you is what is your data and how is it distributed? Drop down menu, exponential, click, run the simulation, and get the statistical information to make the decision. Or you're going to transpose some of these distributions into normal distributions to then run the statistics to get the information to then make the decision, recommendation from a business standpoint. So distributions are really important to understand. And then the mean, the median, and the mode. What's the mean?
Average.
Just the average. What's the median?
Middle value.
What?
Middle value.
Yeah, it's the middle value. You rank them from high to low, you pick the middle. And then what's the mode?
The number of people most frequently.
Yeah, exactly. So show me an example of the two. Okay? Give me the definition, show me the equations. Show me an example of the two. I'm just testing you. Okay? And actually the modes have become more important over the last 10 to 20 years because of big data applications. So the most reoccurring now, we can run them off huge data sets. Okay? The median is valuable, but we rather use means. So usually what we would do is we would take the data set, normalize it, take this 2 standard deviation filtering, get rid of the outliers, and calculate the mean. But if you don't have time for that, the median is a quick way to do it. Now, if you have a good data set with very good, tight distributions, are the mean, medians, and modes going to be close to each other or further apart?
Close.
It's going to be close to each other. And if you have close measurements, what does it measure?
Central tendency.
Central tendency within the distribution. And is that what you want?
Yeah.
Yeah. Yeah, that's what you're looking for. So it's part of data visualization. When you're looking at the data, looking at the minimums, looking at the maximums, looking at the standard deviations, looking at the ranges, looking at the standard deviations, look at the mean, median, modes. Those are all diagnostics that you have to do first before you start doing the analysis. Okay? And then tell me what skewness, kurtosis, what elliptokurtic distribution looks like. Show me some examples. Give me a definition. Okay. Elliptokurtic is probably the worst. Okay. Fat tails, skewed. It's basically the financial crisis or COVID. Okay. How do you model COVID impact on the economy? How do you model the financial crisis? It's not a normal distribution. It's a totally messed up distribution. So how do you deal with messed up distributions with thick tails on one side or thin on the other, skewed? There's a lot of data manipulation that you got to go through to clean up the distribution and try to get the data set to where you could actually use it. So it's really hard. Okay, that's the most messed up one. Okay, again, data visualization. Histograms. Okay, you're basically taking ranges of the data and putting them into bins, into buckets, and you're getting the counts. So histograms actually are a good way to look at data distributions. Okay, stem leaf is another, box plot is another. This is basically your advanced data visualization area. Okay, did you guys go through any of that stuff?
Yeah.
Okay, so a lot of this is review. Okay, and then variance. When you hear variance in the standard deviation, when you hear variance in standard deviation, what pops into your head?
Standard deviation?
When you hear variance in standard deviation, what pops into your head? One, it's a mathematical calculation, but it measures